Morning, everybody. Welcome to our tax conference on investing in Africa. I think some of you will know that we've given a couple of these conferences over the last year or two on investing in various countries. Today, we're going to focus on Mauritius. It's a hybrid conference, as the audience will realize. We've got most people online and some people in our various offices in Africa. So it's the first time we've done a hybrid conference. So if there is the odd blips with the technology, please excuse us, but hopefully all things will run smoothly. Today we've got speakers from our office here in Sandton in South Africa. We've got speakers from Mauritius, Uganda, Tanzania, and Zambia. So welcome to all the people in those jurisdictions. I just want to pay a particular welcome to two external panelists who've kindly agreed to come and assist us with the conference. Firstly, in Sandton here, we've got Pravisha Rampal from Phatisa. Thanks you very much. And I did thank you already, but thanks again for joining us. And we have Fiona Thomas, who's from Standard Bank in Mauritius. I can't see you, Fiona, but welcome. I think everybody's seen the agenda, so I'm not going to run through it in any detail, but just to emphasize, we've basically split the day into four sessions. The first session we'll talk about Mauritius as a viable springboard for investing into Africa, as a holding company, things like that. The second session will be a panel discussion led by my colleague, Robyn Berger, that she'll focus on the practical impact of these issues. And no doubt she'll talk about things like the impact of BEPS, substance requirements, avoidance legislation, stuff like that. So I'm looking forward to that discussion. The third session is a comfort break. You'll be happy to know. Light lunch for those who are at our offices. We'll try and limit that to 30 minutes, but we'll keep you updated as to the timing. And then after lunch, we're going to discuss Mauritius as a jurisdiction for IP ownership, licensing, things like that. So we aim to finish at about 3 or 3:30, somewhere in that region, just to let you know. Just on a housekeeping issue before we start, if you're online and you've got some questions, please put them in the chat box, and we'll try to answer them either at the end of each session or maybe right at the end. If we don't get to them, we'll endeavor to make sure each person gets an answer to their question afterwards. Just before we start, I just want to thank Robyn in particular and her team for organizing this seminar. It's not always easy, and all of you people know that lawyers in particular can be quite difficult. So trying to herd cats that happen to be lawyers as well is something quite a challenge. But thanks Robyn, and thanks for all the people in the various jurisdictions who prepared slides and organized. So I hope you all enjoyed the day. To start things over, I'm going to hand over to my colleague Fazil Hossenkhan and Javed Niamat in Mauritius. They're going to set the ball rolling and set the scene by discussing recent developments in Mauritius. So over to you, Fazil.
Morning, everyone. Very pleased to be joining. I'm sorry, there's a bit of an echo. I'm sorry, please bear with me one moment. All right, I think this should work. Thank you very much, everyone. Sorry for this slight mishap. So it's a great pleasure to be joining you all for this workshop on this webinar on the tax aspects of investing in Africa. Focusing on Mauritius as an investment, as a platform for onwards investment. I am joined today by my colleague Javed Niamat, who is our tax expert, and I will be introducing the topic, and Javed will be speaking particularly on the tax reforms that we've had in the recent years. So I will start off with maybe a bit of history to really introduce the topic. As you know, Mauritius has been used for a number of years, firstly as a platform for investing into India, and more recently, maybe in the last 10 years or so, as a platform for investing into various countries of Africa. But it is also used for investment onwards into Europe, China, and other parts of the world. Now, where did this concept come from? And that's why I want to pause on a bit of history very briefly. As you may know, Mauritius was, is a small island. It doesn't have a huge amount of natural resources. It started off since its independence in 1968 as a agricultural-based economy. So the reforms and the transition from an agriculture-based economy to one of a services-based economy has been over a very short span of time. This was introduced maybe around 1980s. We had the first sort of concept of an offshore, and it was incidentally through something which we call the export processing zone. It was nothing to do with services, but I think it's important to pause there because that was the first concept of offshore. So basically, the government then wanted to diversify, move out of the monoculture economy, and introduce manufacturing and value-added services. So they created a space, an economic zone, where promoters, foreign investors could come and set up factories, plants for producing mainly textile, but also other type of commodities for onwards export. Now, these zones benefited from tax incentives, business facilities, cheaper loans, and all kinds of development really to attract talent and really springboard Mauritius into the next phase of its development. Now, building on this same concept, Mauritius then introduced the free port, where goods could transit via Mauritius without entering into the domestic economy and would not be faced with customs and excise. This coupled with the export processing zone really marked the entry of Mauritius into sort of the manufacturing industrialization era, led to a rise in the standards of living and an increased sophistication of the economy. Now, in the mid 80s to the early 90s, building again on the same model, the government went into the area of financial services. So the beginnings were quite humble. Excuse me. Yes, so this works. So the beginnings were quite humble. There was the creation of a regulator which was going to promote as well as regulate the creation of offshore companies, and the idea was really to mimic in some way other smaller economies using their countries as a springboard, as a domicile for either registering trusts, SPVs, funds, and a plethora of different kind of companies for onwards investments in other countries using their tax treaty networks. In parallel, the government redoubled its efforts to expand its tax treaty network to cover more and more countries so that it becomes interesting to do business via Mauritius. Now, we knew that this was not going to be a viable model. Just doing company domiciliation was not the direction that the country wanted to go to. It wanted to, similar to the likes of Singapore and Hong Kong, it wanted to branch into the provision of sophisticated financial services and really get into being a services-based economy. In around 2001, there was increased appeal for international norms to be adopted, and this is when the Financial Services Commission was created, when really there was a framework placed both for the provision of financial services, such as fund management, such as private wealth management, and also leasing and some smaller forms of lending business. While this was going on, Mauritius was also using its treaty network and its adherence to trading blocks like the SADC and COMESA to really build upon its projected role as a platform for doing business on the continent and with the rest of the world. Now, after having operated in this sphere for quite some time, I think the country became increasingly prominent as a jurisdiction where a lot of business was being channeled, and this attracted the attention of international bodies, norm-setting institutions, where the country was increasingly called upon to adopt international norms. Can I have the next slide, please? Thank you. Can I have the next slide, please? Right. So the challenge came from two directions. We had firstly the OECD questioning some of the tax practices. We have what we in those days we had what is now known as the global business regime. The global business regime came under attack because the country practiced for those who remember, an automatic tax credit of 80% of Mauritius tax. And the criticism was that this led to a differential treatment of citizens, of residents versus non-residents. The result of this was felt by development financial institution calling upon Mauritius to either to either avoid Mauritius because it was practicing what they deemed to be harmful tax. The result being that other countries were suffering from an outflow of capital using harmful tax jurisdictions to channel capital. Now, as a result of this, in around 2018, there were wide reforms, and Javed is going to be talking about some of these reforms and how the automatic tax credit was abolished. It is now replaced by something which we refer to as the partial exemption regime, and there's no longer a ring fencing of residents and non-residents. The certain exemptions are allowed in certain types of income, based simply on the fact that there is business being conducted outside Mauritius, and this can be availed of by residents as well as non-residents. There was the introduction of substance requirements in response to concerns by the OECD that multinationals were making use of Mauritius without creating a valid presence, but simply to make use of the tax treaty network. There was a second fold of these challenges which the country faced, and that was on the the anti-money laundering front. In 2020, well, before that, Mauritius had adopted the FATF 40 principles. It was an active member of ISAMLAC, which is the regional group of the FATF for the African region. However, in around 2019, 2020, the FATF perceived that there had been some failings. There were 6 recommendations out of the 40 which Mauritius had failed to demonstrate that it was properly implemented. And although the financial systems the financial services industry had well implemented FATF recommendations, and we had a plethora of laws dealing with regulation for anti-money laundering purposes, there were some segments of the economy, namely the liberal professions, barristers, solicitors, and notaries, that felt somewhat out of the loop of regulation. And we were also pointed for not having adequate enforcement mechanisms of our various AML laws. Now, the repercussions of this was quite serious. Some of you may already know that Mauritius was on FATF grey list between 2021 and 2022. We managed to get off the grey list earlier this year after several undertakings having been given by the government of Mauritius and a number of laws having been changed. And I think the economy was profoundly marked by being on the grey list, because at the same time that it found itself on the grey list, the European Union placed Mauritius, by the fact that it was placed on the FATF watch list, on a blacklist. And the reason was simply that the European Union did not practice a grey listing. It only had a white list and a blacklist. So which meant that, given that it was being supervised, Mauritius was being observed by the FATF in terms of how it comes to adhere to the norms. The EU found no other option than to put Mauritius on a blacklist. And the results of this was quite widely felt, because unlike the previous challenge we had from the OECD, where global business companies were being avoided by DFIs, this FATF-related problem had repercussions on the whole economy, because bank transactions were being impacted, and all counterparties dealing with Mauritius had to apply enhanced due diligence, which created incredible delays in completing transactions. We ourselves had witnessed a decline in the number of businesses using Mauritius as a platform to go into countries in various other countries. New funds. My practice area is that of funds, and we witnessed a very sharp decline in the number of new setups. Now, in 2020, in order to allay the fears of the international community and also address the concern of the FATF, wide-ranging reforms were introduced by the government in terms of anti-money laundering regulation. And I'm going to be talking about this in more details afterwards, towards the end of this presentation. But Mauritius has had to adopt quite intrusive KYC in order to be able to get off the FATF grey list, which it managed to do earlier this year, and late last year, and this led to earlier this year being removed from the EU blacklist as well. So as we speak today, Mauritius is now back to being on the whitelist and fully adherent to FATF principles. It was found, I think a matter of a couple of weeks ago, to be largely compliant with all of FATF's recommendations. I'm just trying to change to the next slide, please. Thank you very much. Now, what underpins these reforms is not simply a matter of getting off one list and getting into another list and constantly having to fight off concerns being addressed to Mauritius about it either practicing harmful tax regimes or not being compliant with international standards. The government realized that in order to future-proof itself for the future, there needed to be a drastic policy change. And in 2020, it came up with what it called the Blueprint for Global Business. Global business was the new name for offshore because it signified moving away simply from doing offshore, simply from being a country where it's beneficial for tax reasons to be present, but more of a substantive economy where it makes sense to be present to conduct international business, hence the term global business. Now, there were some distinguishing factors which I would emphasize on by moving from the offshore to being the classic offshore center to being the international financial center of excellence that it wanted to project itself to be. And the timeline for this that the government has announced would be up to 2030. So we have about 10 years to complete this, but already the initial foundations of the new international financial center are being laid out. Now there are the blueprint identified 5 limbs of this development. Firstly, the business environment. It must be a business-friendly country. There must be investment in human capital, and I think this is something which the country has always been known for. It disposes of qualified and high caliber professionals. The infrastructure has to be there, and there needs to be a more further financial sector development in terms of the products and the offerings which can be availed of using Mauritius. And we also had to be staunchly protective of the integrity and the reputation of the island, because as we had experienced, reputation means everything. Being on the FATF grey list and the EU blacklist has, during that period that we were on there, led to a number of difficulties, and I think it's a lesson well learned for our country. And now the government is really redoubling its efforts not again to slip into a grey area again. Now, the imperatives of the blueprint was to not only provide an area to do business, but really provide all the facilities and the conveniences that come with operating from a financial center, right? It had to be a system that is future-proof for the future and continues to evolve in the light of international norms. It had to attract the right talent. It had to be able to offer the right product and services, and the laws had to continue evolving in order to be in step with international developments. So at the same time, if the country realized that if you're trying to attract talent, there must be the facilities around accommodation, around schools, around payment systems, just general infrastructure, so that people are incentivized to stay in Mauritius. Can we have the next slide, please? Thank you. So I'm just going to be briefly talking about what has been introduced now in the aftermath of the grey listing. We have witnessed a number of developments. It's just very easy now to set up shop in Mauritius. The country has been known to be one of the easiest places to do business in Africa. That offering has been expanded to allow non-residents to come and live and benefit from various schemes, not only to live and work, but also to own property on the island. So I will not go into the details of their various schemes, but we have a number of what we call the smart city developments, where expatriate workers who will work for businesses that we're seeking to attract on the island can live. There are a number of schools, private schools, for their families and their children to attend. And in parallel to this, the financial services regulation has been introducing new vehicles, new products. You know, we have the virtual assets regulation, which provides for the licensing and the custody of virtual assets, tokens, and digital currency. There is the prevalence of family offices, because not only we have to attract talent, but we also have to cater for how these people would deal with their net worth. How will they do their tax filings? How would they manage their personal wealth? So emphasis has been placed onto all these aspects in order to make the IFC that Mauritius projects to being in 2020 an all-encompassing jurisdiction. Coupled with that, we have reviewed holistically the tax, the tax system. I believe Mauritius now offers an innovative tax, still flexible. Of course, some undertakings have had to be given, some compromises have had to be made, but it's all in an endeavor to continue to provide a competitive rate of tax, an easy to use tax system, a user-friendly tax system, as well as one which adheres with international norms so that it is future-proofed against challenges by international norms. Since we are coming to the tax, I think it's a good time for me to just ask Javed to speak on the various reforms, unless there are any questions for me at this stage. I think we can continue, Javed.
Thank you, Fazil. Hello, everyone. The Mauritius tax regime has gone through major reforms for the past 5 years. The preferential tax regimes of Mauritius were assessed by both the OECD Forum on Harmful Tax Practices and the EU Code of Conduct Group. Since major reforms were needed, because some of the regimes were found to have potentially harmful features. As mentioned earlier by Fazil, one of the major tax reform was the abolition of the deemed foreign tax credit regime. This regime was available only to GBL1 entities and banks with respect to their banking business that give rise to foreign source income. So this regime was ring-fenced, and under this regime, it was presumed that foreign tax charge on the foreign source income of the qualifying entities was equivalent to 80% of the Mauritian tax chargeable on that income. So there was no requirement for the entity to actually suffer foreign taxes or to provide evidence of actual tax paid in order to benefit from the foreign tax credit. The Mauritius tax chargeable is 15%, with the 80% presumed foreign tax liability being offset against the Mauritius tax liability. These qualifying entities were actually being liable to a maximum effective tax rate of 3% on their foreign source income. So as I mentioned, given that this was ring-fenced, this was considered only to GBL entities and banks with respect to their banking business that gives rise to foreign source income. This was considered as harmful. So we have abolished this regime, and as a replacement to this regime, a partial exemption system, which is linked to enhanced substantial activities requirements, was introduced on specified types of income. The partial exemption regime is not applicable to all income, and it applies to, for example, foreign dividend, interest income, and certain, and all income of certain category of companies which hold a specific license, such as a collective investment scheme, a closed-end fund, a CS manager, etc. The partial exemption regime is not a given, so there are certain conditions and substance requirements that need to be met, and the substance requirements differ between the type of income that is for which it is being claimed. For instance, in respect of foreign dividend income, one of the conditions is that the foreign dividend must not be allowed as a tax deductible item in the source country. And in terms of substance requirement, the company is required to comply with all its filings obligations under the Companies Act and the Financial Services Act. The company is also required to have adequate resources for holding and managing share participations. In this respect of interest income, the partial exemption regime does not apply to income derived by banks, non-bank deposit institutions, etc. But it applies to other type of entities. And in order to benefit from the partial exemption regime on interest income, one of the substance requirements is that the company must carry out its core income generating activities, which is its essential activities that generate its income in Mauritius. And this can be satisfied by agreeing funding terms at board meetings in Mauritius. Another subset requirement is for the company to have adequate number of suitably qualified persons to conduct the core income generating activities of the company in Mauritius. And lastly, it must incur a minimum expenditure which is proportionate to the level of activities. So there is a people and functions requirement in order to benefit from this partial exemption regime. Another major change was the abolition of the GBL2 regime. So the previous GBL2 license companies were exempt bodies for tax purposes, Accordingly, they were not liable to tax in Mauritius. And also, the GBL2 entities had no requirement to be managed and controlled outside of Mauritius, and hence it had the ability to avoid the creation of a taxable presence outside of Mauritius, and hence not be liable to tax anywhere. This was also considered as harmful, and the Mauritian authorities introduced, in replacement of the GBL2, the authorized company. The authorized company is a new type of company which holds a license, which holds an authorization, from the FSC. And it is not an exempt body, as was the case for the GBL2. However, it is required to have its central management and control outside of Mauritius. Hence, there is possibility of such an entity having a taxable presence outside of Mauritius, i.e. in the place where it has its central management and control. And also, given that the authorized company is not an exempt body, so it is liable to pay tax in Mauritius in the event that it derives income from Mauritius. It is also required to file a return of income to the Mauritius revenue authorities. So there is also transparency in respect of the authorized company. So these were the domestic measures that were taken to counter the harmful tax measures. Now I will go to the next slide, which is the implementation of Mauritius of BEPS minimum standards. Mauritius is supposed to know that Mauritius is a member of the OECD Inclusive Framework on BEPS since November 2017, and Mauritius has implemented the OECD Base Erosion and Profit Shifting Project minimum standards. The BEPS project identified 15 actions to equip governments with domestic and international rules and instruments to address tax avoidance, to ensure that profits are taxed where economic activities are generated and performed and where value is created. There is an obligation for states to implement a minimum standard with regard to combating harmful tax practices, which is Action 5 of the BEPS project. There is also the inclusion of abuse clauses in double taxation agreement, Action 6, country by country reporting, Action 13, and the dispute resolution mechanism, Action 14, which are all the 4 minimum standards that need to be complied by states. In terms of Action 5 of the BEPS project, Mauritius has made various changes that I mentioned earlier to its tax regime, and hence all the standards set by the OECD Forum on harmful tax practices are met by Mauritius. Regarding Action 6, which is about prevention of tax treaty abuse, this is also a minimum standard. It addresses treaty shopping to ensure a minimum level of protection against treaty abuse. Mauritius has amended its tax treaties through the Multilateral Convention, which is an instrument that modifies all covered tax agreements in a fast and effective manner to implement BEPS treaty-related measures. The amendments made to the tax treaties of Mauritius include an express statement in the preamble that the common intention of the double taxation agreement is to eliminate double taxation without creating non-taxation. Mauritius also added a principal purpose test, whereby it specifies that treaty benefits may be denied if one of the principal purposes of the treaty benefit of one of the purposes was to obtain a tax benefit. Now we can go to the next minimum standard, which is the country by country reporting. Under Action 13 of the BEPS projects, all large multinational enterprises are required to prepare a country-by-country report with aggregate data on the global allocation of income, profit, taxes paid, and economic activity among tax jurisdictions. The CBC report is shared with tax administration in these jurisdictions. Mauritius is a signatory of the multilateral competent authority agreement on the exchange of country-by-country reports, and it has also passed regulations to enable exchange of country-by-country reports as from the fiscal year 1st July 2018. Country-by-country reporting applies to MNEs having a consolidated group revenues of euro 750 million that has 2 or more enterprises which are tax residents in different jurisdictions. Mauritius has also created an online platform for country-by-country reporting, which was launched in July 2019. Lastly, the minimum standard for improving dispute resolution is under Action 14 requires a jurisdiction to allow a taxpayer to present a case to the competent authority of either contracting jurisdiction for mutual agreement assistance. The Mauritius treaties were amended under the MLI, which include the mutual agreement procedure to improve dispute resolution. So this allows a taxpayer who is taxed contrary to the provisions of a tax treaty to present his case to the competent authority of either contracting states. If the competent authority is unable to resolve the matter unilaterally, the competent authorities of both contracting states must consult to endeavor to resolve the matter by mutual agreement. Hence, this makes dispute resolution much more effective. While these were the BEPS minimum standards, Mauritius has also adopted other anti-avoidance measures. For example, Mauritius has adopted the control foreign company rules in line with the recommendation on the BEPS Action 3, which is not a minimum standard. The CFC rules is designed to prevent a parent company from artificially moving its profits abroad to a controlled subsidiary in a country with a more favorable or lower tax rate. The EU has acknowledged that the CFC rules adopted by Mauritius is broadly aligned with those of EU's anti-tax avoidance directive. Under the CFC rules, a CFC is defined as a company which is not resident in Mauritius, but is owned and controlled by a Mauritian resident. The CFC rules allow the Mauritian Revenue Authority to tax non-distributed income of a CFC if it arises from non-genuine transactions with a view to obtain a tax benefit. However, there are certain exemptions and threshold requirements for the CFC rules to apply. For instance, the CFC rules do not apply if in a particular year, the accounting profit of the Mauritian entity is less than euro 750,000, and the non-trading income is not more than 75,000 euros. Another exemption is where the tax rate in the country of residence of the CFC is more than 50% of the Mauritian tax rate. Finally, Mauritius has recently brought the global anti-base erosion rules, which is known as the GLOBE rules, into the Income Tax Act. The GLOBE rules were developed by the OECD G20 Inclusive Framework on BEPS, which provides for a coordinated system of taxation intended to ensure that large M&E groups pay a minimum of 15% tax on the income arising in each of the jurisdictions where they operate. The rules create a top-up tax to be applied on profits in a jurisdiction where the effective tax rate determined on a jurisdictional basis is below the minimum 15% rate. Mauritius is among the early adopters of the global rules, and this reaffirms the commitment of Mauritius to OECD principles and demonstrates the prompt actions against tax-based erosion and profit shifting. The global minimum tax is applicable only to resident companies forming part of an M&E, and it is similar to the application of CFC rules, which i.e. it applies to entities having global annual revenues of at least 750 million rupees. In terms of the impact of the global minimum tax on Mauritian entities, given that Mauritius is used as a holding company mostly for companies operating in Africa, and given that the withholding taxes is quite high in Africa, so we do not anticipate any major impact on the Mauritian companies. Also, it is also the finance minister will be passing regulations about the global minimum tax, and this global minimum tax rule is still yet to be proclaimed. In terms of conclusion, what we can say is that following the reforms made by Mauritius, the OECD Forum on Harmful Tax Practices is now satisfied that Mauritius does not have any harmful features in its tax regime, including in the partial exemption system. The EU has also confirmed that Mauritius complies with the good governance tax principle of the EU and is not a tax haven. These tax reforms, including the implementation of the BEPS minimum standard, fit very well within the strategy of Mauritius to be recognized as a well-regulated, transparent, and compliant jurisdiction. Thank you.
Thank you, Javed. While you are on this, I see there's a question which may be relevant. There's a question from Wilfred asking, how do we balance the tax practices reformed and the new requirements for substance instead of having shell or shelf companies in Mauritius? I think the short answer to this is firstly that we don't have shelf companies possible. It's never been done, right? Would you like to comment on this question?
Yeah. So yes, thank you, Fazil. Yes, we don't have shell companies, and with major reform, so there is the peoples and functions requirement. So it is necessary for a company operating in Mauritius, either as a holding company, to have a minimum substance in Mauritius, whether from a regulatory perspective or in order to benefit from the partial exemption system. Hope that is answered the query.
Thank you very much, David. I will just conclude, just mindful of time, just brief.
Sorry, Fazil, I think you're on mute.
Sorry about that, everyone. Yes, so I wanted to, just mindful of the time, I just wanted to briefly conclude on the changes that have been brought by legislation on the AML front. we realized that for many of you who already do business in Mauritius, that this was perhaps a bit of a brutal change in terms of the KYC. But I think regulators and service providers continue to learn from the new norms that they need to adopt. So essentially what, if I can, in a nutshell, summarize the AML changes, they have focused on two main things. Firstly, there has been a renewed focus on who the beneficial owner is and what type of KYC is needed on the beneficial owner, in recognition that with business, a number of times, the beneficial owner is a person which lies after a number of layers of structuring. So the changes have cut across, whether it is the Companies Act, the Limited Partnership Act, the Foundations Act, the Trust Act. All these legislation have been updated to include the notion of the beneficial owner, who that person is, what is the sort of control we're looking at to identify a person as a beneficial owner, and of course, what type of KYC is needed. There is more intrusive KYC. The requirement for service providers now is that they have to use intrusive KYC to really know what is the source of funds and ensure that it is not from any proceeds of crime. But this is what appears to be quite harsh requirements is counterbalanced in some way by a mitigating factor, which is the risk assessment that has to be conducted. So in very briefly, anti-money laundering regulation relies on a business risk assessment of the applicant for business. And this is new, and this is something which is still being developed. I think it's being learned on the go as to, you know, businesses now have to have a risk matrix, identify whether their counterparties fall within the low, medium, or high risk, and there are different levels of KYC and customer due diligence which has to be applied depending on the risk. So if it is a low risk, so the KYC is pretty much as it was before, except perhaps for more documents required to establish sources of funds. Of course, it is high risk, then we can expect a higher degree of scrutiny by whether the regulator or the service provider. I will just conclude this part by saying that the last wave of reforms has been somewhat in response to the international community, and it demonstrates that the country is determined to do whatever it takes to maintain its reputation and remain a viable jurisdiction for doing business. By going through the reforms in tax, which obviously meant compromises on a number of fronts, which David has spoken about, by doing the various hoops of going through the EU, the FATF assessment and the EU assessment for anti-money laundering compliance, the country is demonstrating that it's really looking towards establishing itself as being a jurisdiction of substance, where promoters, investors can have confidence in conducting their business. And that concludes my presentation.
Fazil, thank you so much. We're now going to skip over to Bowmans Kenyan office, who are going to share some insights with us around.
I will just pass along to my partner in the Kenyan office.
Thanks, Fazil.
Andrew.
Andrew, can you hear me? It's Robyn.
Yes, I can hear you, Robyn.
Thanks. I just wanted
Yes. Andrew,
our
I believe
audience.
your mic is still muted.
I just wanted to share with our audience, because I see we now have over 100 people online listening in. So Santon office, please don't think
you
you're
can go
alone
ahead.
and there's only us. I'd just like to let everyone know that we're now going to move across the different Bowmans offices at this stage, and everyone will give us some insights on how their countries see investments coming from Mauritius. So we look forward to some insights in this regard. And again, I just want to encourage people to please put questions in the chat if you have any. Thanks so much. Over to you, Andrew.
Thank you, Robyn. Can you? Robyn, can you hear me?
Yes, go ahead, Andrew.
All right. I think there's a bit of an echo, but if I fall, kindly just let me know. Thank you, Fazil and Garven, for launching us into the Kenyan considerations. I'm going to conduct this session jointly with Alex, who's my partner in the Kenyan tax practice, and he's going to talk about the more practical aspects from a Kenyan perspective. I'll just give a brief introduction that will then launch into Alex's bit on the practical perspective. Usually, when entities are looking to invest in Kenya, one of the more common questions that we get asked is, what is the ultimate holding company jurisdiction that will enable the multinational enterprise set up in Kenya and operate efficiently? And the traditional considerations, at least from a Kenyan perspective, for a holding company have been one, the taxation.
Andrew, so sorry to interrupt. Can I ask anyone who's not speaking to please go on mute, because you're creating feedback with Andrew's discussion? So sorry.
Yeah, I think they just need to drop their volume because they're in the same room.
Sorry, just a moment, Robyn. Robyn, can you hear me now?
Much better. Thank you so much.
Oh, great. Thank you. So I was just saying that the question that we get asked quite often is, what is the ultimate holding company jurisdiction, or the best holding company jurisdiction that a multinational enterprise can set up so that it can transact its operations efficiently from a tax perspective? And some of the traditional considerations from a Kenyan perspective have been, one, the tax treatment of incoming dividends from the jurisdiction of the subsidiary. And the idea is to either have a situation where those dividends will not be subject to taxation in the subsidiary jurisdiction, or will be subject to taxation but at a low tax rate. And this is where double tax treaties come in, because they will typically reduce the tax rates to be applied on those dividends. The second consideration would be, once those dividends arrive at the holding company jurisdiction, how will they be treated there? Are they going to be exempted from tax in that jurisdiction, or are they going to be subjected to a low tax rate? The third consideration is when those dividends are then being paid outwards to the shareholders at the holding company level, then will they be exempt from taxation, or will they be subject to taxation, and at what rate? The ideal situation would be to have a lower tax rate on those outgoing dividends. The fourth consideration would be on the interest element, because a lot of financing for the subsidiaries in the other jurisdiction usually comes from the holding company, who will typically obtain funding from either financial institutions or their shareholders. And so the idea is to be able to get relief for the interest expense that will be incurred on those on that lending from the holding company down to the subsidiaries. The fifth consideration is usually around whether there'll be capital gains tax implications at the level of where the shareholders of the holding company want to transfer their shareholding. Will that transfer of shares attract capital gains tax at the holding company's jurisdiction? Further, we would look at whether the jurisdiction of the holding company has got a broad treaty network, tax treaty network, because of course this would allow the entities to enjoy the benefits that accrue as a result of those treaties, subject of course to local laws on substance requirements that Fazil and Javed already talked about earlier on. And so broadly speaking, these are the areas that we'll typically look at when considering, when entities are considering investing into Kenya through Mauritius. And the other thing that I would like to add perhaps at this point is that prior to 2006, Kenya did not really have an elaborate legal framework that would govern transactions between related parties. We had a general law that provided that transactions between related parties must be at arm's length, but there really weren't any detailed rules or regulations that would govern how that would happen. However, in 2006, Kenya implemented the transfer pricing rules that would then govern those transactions, and those rules then came up with procedures that these companies would be required to adhere to, documentation that they would be required to keep to be able to demonstrate that their transactions were at arm's length. Now, what the Kenya Revenue Authority noticed, even in the course of implementing these rules, is that a lot of these entities were engaging in what they would refer to as aggressive tax planning measures, which is around moving profits to jurisdictions that had low tax rates, shifting expenses to jurisdictions that had high tax rates, and distributing dividends, in a manner that would result in the lowest amount of tax to be paid. And the problem that the Revenue Authority had with this is that these profits were being allocated to these jurisdictions, but there was no link between the profits allocated to those jurisdictions and one, where the functions were actually performed to derive that income, two, where the risk was assumed, and three, where the intellectual property was actually held. And so for these reasons, Kenya developed a very robust system of auditing multinational entities, conducting tax investigations to confirm that these transactions were actually being conducted at arm's length. With that background, I'm now going to cede to Alex to go into the more practical aspects of the Kenyan side in terms of investing through Mauritius. Thank you, Alex.
Thank you. Thank you, Andy. So I'll start off by capital gains tax. As Andy set out, the tests, a number of the tests we are looking at when deciding which holding company jurisdiction to use is CGT. Now, in Kenya, CGT applies at the rate of 5%. This rate is going to increase to 15% from the beginning of next year. This is if you transfer shares or property in a Kenyan company. And this applies to Kenyan residents as well as Kenyan as well as non-resident sellers. Of course, this is subject to DTAs. You will need to look at the particular double tax treaty in place to see whether it shifts the taxation of that capital gains tax. For example, if you look at the Kenya UK DTA, when a UK resident person sells shares in a Kenyan company, then the taxation of that has been shifted to the UK. When there's an indirect disposal of shares in a Kenyan company, that is currently not subject to tax in Kenya. So one common restructuring option is to, and this we see commonly for investment firms, private equity funds, VC funds, is to have a holding company, SPV, typically in a holding company jurisdiction. The most common is Mauritius. And when they are exiting to effect the sale of shares at the Mauritius level rather than in Kenya. That way, no capital gains tax is paid in Kenya. When we come to withholding tax, when paid to non-resident persons, the dividend withholding tax rate is 15%. This depends, can be reduced where there's a double tax treaty in force. As to the use, just moving on to the next slide, as to the use of Mauritius as an intermediary holding company jurisdiction, this is very common for persons investing in Kenya and the region, as my colleagues will talk about. A few years back, we used to see other jurisdictions, for example, Jersey, Seychelles, sometimes Netherlands. But I think now with what Fazil was talking about in terms of the improvement in the climate in Mauritius, its close proximity to Kenya, 99% of the time we are seeing Mauritius as the most commonly adopted holding company jurisdiction. We still get questions about the UAE, but I think side to side, when we do the analysis, should you use Mauritius, should you use UAE, the common decision is to use Mauritius as the holding company jurisdiction. Of course, when you use any holding company jurisdiction, including Mauritius, then you have to check the substance requirements, whether you satisfy residency test. Now, what the Kenyan law provides is that a company is considered tax resident in Kenya if management and control is exercised in Kenya. And the question, this is a common audit issue by the Revenue Authority, where you have a holding company in Mauritius, but the board sits in Kenya, maybe two resident directors in Mauritius, but most of the decisions are made at the Kenya level. And in that instance, then the Revenue Authority has deemed that this company is actually controlled in Kenya, managed and controlled in Kenya, and is taxable in Kenya. So this is a common thing to watch out for, to ensure that management and control is exercised at Mauritius, where you use Mauritius as the holding company jurisdiction. We do not have, just moving on to the next slide, we do not have a DTA between Kenya and Mauritius. One had previously been signed. This was held to be invalid by Kenyan courts because it had not been tabled in Parliament. A new one was signed in 2020, but this has not yet been effected. There's been no exchange of instruments yet. This DTA will lower certain withholding tax rates. For example, the dividend withholding tax rate will be reduced from the standard 15% to 8%. It's something that we are all looking forward to. But having said that, the fact that there's currently no DTA in force between Kenya and Mauritius does not deter either private equity funds or multinationals that want to set up a holding company jurisdiction. Mauritius still remains the most attractive holding company jurisdiction to use for Kenyan purposes. When you go to the next slide, we have anti-avoidance legislation under Kenyan law. Essentially, if the principal purpose, or the main purpose of entering into a particular transaction is to reduce the liability to tax, then the Revenue Authority has powers, is entitled to come and set aside the transaction so that proper tax is payable under that provision. Now, this is a provision that the Revenue Authority in Kenya relies a lot on when looking at transactions to see was the main purpose of this transaction to reduce the liability to tax. So whenever you do a transaction, then in structuring it, the main purpose cannot be to reduce liability to tax, because the Revenue Authority can either set aside the transaction or adjust the transaction so that the proper amount of tax is payable. Now, we've seen this where in the use of any holding company jurisdiction, including in Mauritius, this coupled with the management and control test, we're using Mauritius holding company is something the Revenue Authority here likes jumping onto and to argue you only went to Mauritius really so that you do not pay capital gains tax in Kenya. And one common defense we've applied in some recent matters is where we've used Mauritius as the holding company jurisdiction, not to avoid paying taxes in Kenya, but because the particular corporate entity, the particular client in that instance wanted to have a Mauritius holding company with subsidiaries across the region, Kenya, Uganda, Tanzania. And it made sense to use Mauritius as the holding company jurisdiction rather than having, say, a holding company in Kenya or Uganda or Tanzania. We do have a limitation of treaty benefit provisions in our law. Just going on to the next slide, this is contained in Section 41 of our Income Tax Act. Essentially, what it says is that for you to benefit under a double tax treaty, for you to get the lower withholding tax rates, then a majority, 50% plus one of the underlying ownership of the person outside Kenya that is trying to benefit from that lower rate has to be resident in the relevant country. Essentially, if you want to rely, for example, on once the Mauritius DTA comes into force on the lower reduced withholding tax rates, then you have to show that your underlying ownership is held majority by Mauritian resident persons, or the entity is listed in that country. Now, this provision is in our laws, but it's not enforced at the time of paying taxes. The way under Kenyan law we pay taxes is through the iTax systems. And as long as there's a double tax treaty in force, without going behind the particular entity to see the underlying ownership, the lower withholding tax rates are applicable automatically. Of course, the advice we give taxpayers, we give clients is, despite the iTax system having that lower rate, please use the proper standard rate where you do not qualify to benefit from the double tax treaty because you do not have a majority of the underlying ownership in the particular country the payment is being made to. I think this is going to be an audit issue in coming years. Andrew, do you have anything to add on the Kenya and Mauritius?
No, I think that pretty much covers it. Just one more point, that given the absence of double tax treaty between Kenya and Mauritius as of now, one of the things that again investors will be looking at is whether that holding company jurisdiction, in this case being Mauritius, given the absence of the treaty, does it have provision in its laws that provide for unilateral tax credit relief so that the taxes that have been suffered in Kenya can be offset against tax payable in Mauritius, and in that way alleviate the incidence of double taxation, that's taxing the same income twice. And so that's another question that we get, that if there is no treaty, does the other jurisdiction have unilateral tax credit relief? And I think this is a critical concern as well. As Alex has said, from a KRA perspective, a lot of attention is paid to transactions that occur in Mauritius, where directors of that entity are actually resident in Kenya. And the questions that arise are usually, what proof do you have that the management and control was actually exercised in Mauritius? Can you show us evidence that board meetings were held in Mauritius? What's the director composition of the entity in Mauritius? Is it majority Mauritian local or majority Kenyan residents? Worst case scenario, if they usually also ask for hotel accommodation receipts, flight tickets to demonstrate that you actually went to Mauritius to hold those board meetings. And can you then produce minutes of those board meetings? Where are the records kept? Is it Kenya or Mauritius? So those are key issues that we see coming up where entities have holding companies in Mauritius. I think with that, we are open to any questions at this stage. Robyn.
Thanks, Kenya team. There's nothing at this stage that I can see. I'm just conscious of our time constraints here. So if you don't mind, I think we're going to move on to Tanzania or Uganda. Who's up next? Uganda. Thank you so much, Kenya.
Thanks, Robyn. This is Ronald. And thanks, Kenyan team, for that presentation. If we can move on to the next slide. Yeah, so for Uganda, the status remains that any discussion about investment into Uganda or onto the continent, especially through the region, as Alex mentioned, has to involve a discussion about Mauritius. That is not only because we do have a double tax treaty with Mauritius, but because of the other reasons that Fazil was discussing earlier. Incidentally, Mauritius is not the most beneficial tax treaty that we have. For example, the treaty benefits offered under that treaty are comparable to what we have with South Africa and India. But there are more favorable treaties which have been highlighted. We have the Netherlands treaty, which reduces the rates up to zero for people who are investing into Uganda. But still, most people who invest through the continent prefer to use Mauritius. So in practical terms, what are the considerations? We do have a capital gains tax regime that is part of the, generally part of how we tax business income. We don't tax capital gains separately. The tax rate for the capital gain is the same as for business income, but we only tax gains that are derived from Uganda. This is an important question, especially when businesses are exiting or when there's a new investment coming in. And the source rules come into play at that time in a very prominent way. So for shares and for ownership, once the share is backed by a movable property located in Uganda, principally, then we will tax that gain, whether it's indirect or direct, at whatever level the disposal takes place. The questions we've been having include what is principally, what is the threshold. The law does not provide what that is. But what we've agreed with the Revenue Authority generally in practice is you look at your balance sheet and determine whether 50% of the assets constitute immovable assets, real estate basically, and buildings. And then the disposal of those shares, if the threshold is below, will not be Ugandan source and therefore will not attract capital gains tax. We've had a few disputes, especially arising from the oil and gas sector, disposal of the mining rights in the Albertine region for oil and gas companies, which gave rise to our introduction of the deemed disposal rule, which is quite similar to Tanzania, as you will see. and the difficulty the indirect disposal caused was how to collect that tax. For example, if the two parties sit in London and dispose of an intermediate shares of a company in Mauritius that ultimately derives value from Uganda, how do you collect that capital gains tax? So we introduced deemed disposals around 1st July 2018, where if there is a change, direct or indirect, of ownership in the Ugandan company over a 3-year period, that company will be the one to have, be deemed to have disposed of its assets directly or indirectly, and then reacquired them at market value. Of recent, there's a lot of challenges and as well litigation going on around what happens now to the valuation. How do we value the assets of this deemed disposal? Do we use book value? Who determines this value? We've had the case here where the Revenue Authority challenged the taxpayers' valuation of their assets, saying it's too low because in fact it gave rise to a loss instead of a gain, contrary to the expectation of the tax authority. My understanding is that they are now working on regulations to guide how a deemed disposal is taxed. There is no guidance in terms of how to determine that value, in terms of how to whether to aggregate that gain with the general income of the company here. We are hoping to see those at the beginning of the next financial year in July. The other thing to consider now in terms of Mauritius is if the treaty indeed applies, we are going to see when the treaty applies who has the taxing rights for capital gains. The treaty indeed allocates taxing rights to Uganda, where the capital gain is derived from the disposal of immovable property or on property located in Uganda. All other gains are taxed in the country of residence of the disposer. In this case, that would be Mauritius. Next slide, please. Yes, we have a comprehensive withholding tax regime that applies generally for all sorts of payments. Essentially, all payments going out of Uganda are subject to withholding tax. Dividends, interest, management fees, royalties, rent, natural resource payments made to a non-resident. The standard rate is 15, but as I pointed out earlier, if the treaty applies and you manage to navigate the anti-treaty shopping provisions, the rate is reduced to 10 for all those payments. For Mauritius, for South Africa, for India, that rate is the same. Next slide, please. So how do you navigate the anti-treaty shopping provisions? Yes, we do have a general anti-avoidance rule, and we do have a provision that makes the treaty superior to domestic law, except for the anti-treaty shopping provision in section 88. And that provision says that you can only take benefit if you are a beneficial owner and you have substance in the treaty partner state. For the last 4 or 5 years, there has been a lot of debate around who is a beneficial owner. The definition of beneficial owner has been amended. I think this is the 3rd time in the last 4 years, because every amendment that has been coming out has been found to be inadequate, or some of it has frankly been illogical. This is the latest one, which came out effective 1st July this year. And when you read the text in relation to natural persons and legal persons, it essentially focuses on who is the natural person behind the company or the legal person we are talking about. Previously, the discussion was about a 50% ownership or control. That has been reduced to 10%. There are nuanced tests which seeks to show who exercises control of that legal person. In this case, that would be the Mauritian company, or who influences decisions. As you can see, some of those tests are quite subjective, and this is a new provision. We have not encountered a dispute or a query yet relating to how to interpret this. No guidance from the URA on how this will apply, but this is where we are now. Next slide, please. So the limitation also says that you must have economic substance. Generally, the URA has been following OECD guidance on international understanding on what amounts to economic substance. And most of the points that have been discussed by my colleagues in Kenya are checked here. You have directors who are Mauritian. Is your company registered and paying taxes in Mauritius? Do you have tax returns filed there? Do you have employees who are stationed there? Where does your board sit? Those are the types of queries that taxpayers are required to meet if the lower treaty rates are to apply. Now, we notice that when you're filing your return similar to Kenya, there is no limit. You can claim, account for a 10% rate or whichever rate you want, but the query normally comes post-transaction in tax audits, where now queries are made on the returns that you filed and the withholding tax rate that you claimed and the exemptions that the taxpayer claimed as well. So this is quite frequent nowadays and quite robust. The URA has established now an independent international tax division solely to look at transfer pricing and treaty compliance. So we get a lot of queries and work coming out of this area of the tax law. Next, please. Yeah. The point what I was trying to make here was that there hasn't been a lot of litigation around it. As I've said, the queries have increased, but we had a case which is currently sitting in the Court of Appeal, where the URA tried to challenge the taxpayers' use of the 10% rate under the treaty with Mauritius. The specific payment was management fees, and the URA challenged the use of the 10% rate on the grounds that the owners of White Sapphire, which was the applicant in this case, were indeed Ugandans. So they did not qualify. The White Sapphire itself was not the beneficial owner of that payment. The matter went to the High Court, and the High Court said indeed the URA has jurisdiction to look into the use of the lower rate, but going to the High Court was not the right forum. So they should use the mutual agreement procedure provided for under the law. Incidentally, both parties appealed this case. There is an appeal and a cross appeal. You could have called it a draw because it's not easy, or it has not been common for Ugandans or even the URA to use the mutual agreement procedure. It's not a common thing. You'd rather go to the High Court and litigate your matter and have the assessment revoked or affirmed. But we are yet to see how this is going to work out in practice. Yeah, so Those are the few things to look out for as far as Uganda is concerned. Most of the other points, as you will see, are quite similar to Kenya and Uganda and Tanzania, as my colleagues will show.
Thanks so much, Ronald. Moving over to Tanzania.
Thank you, Robyn. Hello, everyone. My name is Fabiola, and I'm based in our Dar es Salaam office. So to begin with, I think I must say that there is currently no existing double tax agreement between Tanzania and Mauritius. And so there is no really a particular advantage into investing in Tanzania through Mauritius. However, there are specific country incentives that can be available to shareholders or on transactions that are between the Tanzanian entity and the Mauritian holding company. And in absence of the double tax agreement, I will therefore cover the general tax considerations that one needs to consider when investing in Tanzania through Mauritius. So in terms of direct disposals of shares, disposal of shares in a Tanzanian entity, there are two taxes that would apply on that disposal. One is income tax of 30% on the gain. And the gain in this case is determined by, comparing incomings and cost of the shares. And also there is a stamp duty, a stamp tax of 1% of the consideration. In practice, we have seen the Revenue Authority seeking to adjust the values of transactions, especially if it involves related parties. For indirect disposals of shares, we do not have a regime that taxes the actual disposal at the upper level. However, there's a deeming provision similar to what Ronald has covered, where the Tanzanian entity is deemed to have realized its assets and liabilities at the market value. And so any gain that is determined on the deemed realization will be subject to income tax in Tanzania. The challenge that we have seen with this particular provision, it's commonly known as Section 56 of the Income Tax Act. The challenges that we have seen with this is there is always an argument between the Revenue Authority and the taxpayer as to how the market value should be determined, especially for the assets and in scenarios where there is no comparable similar assets in the market. And also there are extra requirements where this section is triggered, such as the local entities being required to split the accounting years as at the date of change and after that. So it comes with additional compliance requirements. And in some scenarios where there is no continuity of a similar business in a period of 2 years after the change, then there may be a loss of tax attributes. For example, the tax losses that would have been carried forward, those will be lost if there is no continuity of the same business. Next slide, please. So in terms of dividends that accrue on the non-resident shareholder, generally, dividends are subject to withholding tax of 10% in Tanzania, except for Tanzanian entities that are listed at the Dar es Salaam Stock Exchange. These are subject to 5% withholding tax. But other payments, as mentioned by Ronald, would also be subject to withholding tax. Royalty service fees would be subject to 15% withholding tax in Tanzania. And also interest on loans will be subject to 10% withholding tax. For interest on loans, there may be an exemption for investors that are regarded as strategic investors under the Tanzania Investment Act. But this also comes with other fiscal and non-fiscal advantages. And then we do have anti-avoidance provisions in our domestic legislations. For example, the Tax Administration Act has a Section 8 that gives the commissioner powers to make an adjustment if he satisfies himself that there has been a scheme that has been entered for the purpose of conferring an undue tax benefit to a party. And also the Income Tax Act gives the commissioner powers to make an adjustment where there is a transaction between associates and he feels that it was not entered into at an arm's length principle. In addition to that, we do have Section 128 of the Income Tax Act that introduces or imposes restrictions on the application of treaty clauses, and it does have two conditions. One is that the parties entering or seeking to enjoy the benefits under a double tax agreement need to be residents of the contracting states. And two, the parties' underlying ownership need to be 50% or more of the underlying ownership of the parties need to be in the hands of persons that are resident in the contracting state. So for example, if the parties own shares in a Tanzanian entity, but the ultimate individual shareholder is not based in a contracting state, then the Revenue Authority would seek to disregard the treaty clauses. However, the Income Tax Act also contains a provision that says where there is inconsistency between the treaty and the Income Tax Act, then the terms of the treaty will prevail. So to the extent that the treaty does not talk about the 50% underlying ownership threshold, then in my view, this provision to restrict the treaty benefits then becomes redundant. Next slide, please. All right, so I may have covered this earlier, but yeah, so it's also common for most of the Tanzanian entities to have a holding company that is located in Mauritius. We would also give a similar recommendation when advising investors on where to invest in Tanzania, through which country. But as I mentioned earlier, there is no double tax agreement between Mauritius, and therefore the general or normal tax rules will apply. So that is all in a nutshell from a Tanzanian perspective. Thank you.
Thank you very much, Fabiola. We're now moving on to Zambia. Bwalya, thank you.
Hi, Robyn. Hi, everyone. So in relation to Zambia, what we do see, obviously, is when investors are making investments into Zambia, they try to consider, just like everyone else has mentioned, what is the best jurisdiction for which they can have the highest benefit from. And consistently, I think Mauritius has always been a good destination to have a parent or holding company for investments into Zambia. Not only is it strategic in the sense of it being in Africa and it being part of the region, but it has also always, I think in the case of Zambia, for example, it had a double taxation agreement, which had very favorable terms. So in terms of a holding company to hold interests in various African countries, Mauritius tends to be quite ideal. So in relation to Zambia, and I think I'll just go ahead and dive in, there is no capital gains tax in Zambia, but what we've seen and what we do have is property transfer tax, which is a tax levied on any transfer of shares or property such as land and real estate. But it becomes quite relevant when we're talking about property transfer tax to talk about it in the sense of the transfer of shares. So obviously, property transfer tax was only levied on a direct transfer of shares, and that would be restricted to the Zambian entity only. But in 2019, I think there was an introduction that I think there was a feeling by the Zambia Revenue Authority, as well as the Ministry of Finance, that there was a tendency to structure companies and their operations in a way that the property transfer tax was avoided. And that was because the transfer of shares, if at all there was an acquisition, would always occur at the group level, which would be in Mauritius in this case. So what we saw was a recognition that there was a deliberate avoidance by various entities, multinationals, to avoid the payment of property transfer tax by creating an investment company in Mauritius. They then introduced property transfer tax on the indirect transfer of shares. And what this means is that even where there is a transfer of shares, at the Mauritius level, for example, you would still need to pay property transfer tax in Zambia on that transfer. In trying to determine what that would be, is that they would basically say, if it has to be substantive. So for example, if the Mauritian entity has at least a 10% shareholding in Zambia, then they would have to pay property transfer tax on any transfer of shares in the Mauritian entity. This, in trying to determine what that value is, it would be 5% of the value of the Zambian entity to the Mauritian entity. Really, to ensure that regardless of where the transfer is taking place, the Zambia Revenue Authority is able to get the same tax that it would have obtained had the transfer occurred in Zambia. What we also see is that there is no property transfer where it's part of a group reorganization, and you would have been part of that group for at least 3 years. And again, this is trying to capture instances where transactions are purely structured to reorganize and then to avoid the payment of property transfer tax. So now you have to be able to show that you've been part of the group for at least 3 years. Next slide, please. So in spite of the existing tax legislation, Mauritius, as I had previously mentioned, is commonly used as an intermediary for investment into Zambia. And like I said, we had a very favorable double tax agreement. And this was terminated effectively on the 31st of December, 2021. What this double taxation agreement provided for was dividends being taxed at a rate of 5%. And this is instead of 20%. And then interest being taxed at about 10% instead of the 20%, which is the withholding tax to non-residents. And royalties also being taxed at a rate no higher than 5% instead of the 20%. So in the absence of the double taxation agreement, currently you would have to be dealing with Mauritius on the arm's length basis, and the usual tax rules will apply. However, what we do know is that there is a recognition by the government that Mauritius is a very important partner, and that they are putting in place or trying to negotiate another double taxation agreement. I think the idea was to have this in place by the time 31st of December arrived last year, but unfortunately this was not the case. And the reason for the delay is because of the BEPS implementation framework to which Zambia is a party. that they would want to not have a double taxation agreement that is simply negotiated with Mauritius. I think government would like to have in place a policy around what should go into double taxation treaties, and so that there can be an equal treatment of other parties when negotiating the double taxation agreements. So for now, what government is working on, and I think what's taking long, is to come up with the policy around what terms should be in the double taxation agreement, and then to build on that to create the agreement. So we are looking forward to a new DTA with Mauritius. In relation to property transfer tax, is it something that the DTAs provide for, and can you get any form of relief? Unfortunately not. Traditionally, double taxation agreements have never provided for relief in relation to property transfer tax. So this is not something that we do expect to see. But we do expect the government to use the multilateral agreement, the multilateral instrument as a base and as a guiding principle in terms of negotiating new DTAs. Next slide, please. With that said, the government is always still, I mean, we have an express provision in the Income Tax Act, which is the anti-avoidance provision, which most of my colleagues have spoken to. And basically, it empowers the Commissioner General of the Zambia Revenue Authority to be able to consider a transaction and whether or not it was intended to avoid tax, and then to assess what they consider to be the appropriate tax. Like my colleagues in Kenya had mentioned, that regulators, and in this case, the ZRA, will cite this quite a lot in terms of whether or not the structure of a transaction is purely intended to avoid tax liability. And we've seen them cite it quite a bit. But then what we haven't seen is them being able to enforce any action on this basis. I think that they've generally accepted that. I think it becomes a lot more difficult, and I think that's why we haven't seen any further steps being taken. But we do have this anti-avoidance provision, which they can then use to sort of impose various taxes or to disallow certain benefits. We have seen them use it in the sense of, trying to get benefits on whether it's a withholding tax arising from a double taxation agreement, based on the substance arguments that have already been made. So Zambia doesn't have a substance argument or minimum substance requirement for investment, but you will see the Zambia Revenue Authority use that, and particularly use the anti-avoidance provision to determine whether or not you should be entitled to the that you would ordinarily get. I think for us, obviously, if you have the DTA and you're relying on the DTA, the anti-avoidance provisions would not apply. But like we mentioned, there is no DTA currently with Mauritius, and therefore the anti-avoidance provision definitely becomes quite important. Next slide, please. I think that's the end from me. Thank you.
Bwalya, we're now going to move over to South Africa. We're running a few minutes late, but hopefully we'll make it up in the next session, where I'll try and keep the questions to a minimum on the panel. Let's just continue for now. Thanks. Welcome, Esther.
Thanks. Can everyone hear me? Oh. So just looking at it from a South African perspective, if we now have a Mauritius shareholder or company holding shares in a South African company, that Mauritius shareholder as a non-resident would not be subject to capital gains tax in South Africa, except where more than 80% of the market value of the shares is attributable to immovable property in South Africa, and where the non-resident, alone or together with a connected person, holds at least 20% of the shares. Also, this immovable property rich tax will apply where the shares is attributable to a permanent establishment that the non-resident has in South Africa. So the non-resident will need to register as a taxpayer in South Africa and will then pay the tax over to SARS. And it's very important to note that this tax applies irrespective of whether the non-resident directly or indirectly disposes of the shares in this South African company. Just from a dividends tax perspective, South Africa has a 20% dividends tax withholding rate on dividends declared and paid by a South African company to a non-resident. It's also important to note that South Africa has a withholding tax requirement, and this is in terms of Section 35A of our Income Tax Act. So a non-resident will be subject to this withholding tax where the non-resident disposes of immovable property or interest in immovable property in South Africa. So what happens in terms of this provision of the Act is that the South African purchaser is required to withhold at least 10% of the purchase price where the non-resident is a company. So the non-resident has the option to register for tax and to apply to the South African Revenue Service for a directive for a nil rate or a reduced rate of withholding to apply. Ordinarily, or in terms of the provisions of the Act, this directive can be obtained by considering, amongst others, what assets does the non-resident have in South Africa, what security the non-resident will furnish for the tax to be payable, whether or not a double taxation agreement applies for a reduced rate of withholding or for no withholding to apply, and also whether the actual liability of that seller for the tax is actually less than the amount to be withheld. So in this regard, it's important to note that SARS is of the view that the definition of immovable property in Section 35A of our Income Tax Act is extended to include shares in an immovable property rich company. So this means that the South African Revenue Service holds the view that irrespective of what the wording is in the double taxation agreement, and irrespective of whether or not South Africa has then the taxing rights, it will always have the right to tax the disposal of shares in an immovable property rich company. So what we then see in practice is that SARS is not likely to give a directive under number D listed, number C listed there, but is more likely, or what we often see, is to give a directive for number D listed. Just in general, Mauritius is very commonly used as a location in which to establish a holding company or an intermediary holding company that invests into South Africa. And South Africa has concluded a double taxation agreement with Mauritius. And if we look at the terms of the double taxation agreement very quickly, from a capital gains tax perspective, I'm just going to read there from the slides what the provision says. It says that gains derived by a resident of Mauritius from the alienation of shares deriving more than 50% of their value directly or indirectly from immovable properties situated in South Africa may then be taxed in South Africa. There's also another fallback provision which only applies if none of the other provisions in that relevant capital gains tax article applies, and that will again say where the gains from the alienation of any property other than that referred to in the preceding paragraphs of this article shall be taxable only in the contracting state of which the alienator is a resident. But just looking at this, it is very clear then if your non-resident is disposing of shares in an immovable property rich company, that the Mauritius double taxation agreement doesn't prevent South Africa the taxing rights, irrespective of whether there's a direct or indirect disposal. Then looking at the treaty and the dividends withholding tax article. So in terms of the dividends tax article in the treaty, a reduced rate will apply, and this will be 5%, but provided if the beneficial owner holds at least 10% of the capital in the company declaring the dividend, and in all other cases, a reduced rate of 10% will apply. So just moving over to the anti-avoidance legislation, SARS could seek to attack a structure where there's a Mauritius company holding shares in a South African company on the basis of the general anti-avoidance rules. These are contained in section 80A to 80L of our Income Tax Act. And SARS would then seek to argue that the structure that you've used was motivated by the benefits under the treaty. Or otherwise, SARS could seek to apply the beneficial ownership argument. And basically, in terms of this argument, it's like when we looked at the double taxation agreement in the slide before this, the recipient of the dividend will only be allowed for the reduced rate if they are the beneficial owner. And our Income Tax Act in the section 64D that deals with the dividends tax provisions also provides that the dividends tax is payable by the beneficial owner. So SARS will then seek to argue that the Mauritius company is not actually the beneficial owner of the dividend, or it could be similar to interest and royalties. So the concept of beneficial ownership is, like I said, defined in section 64D of our Income Tax Act. And this means that the person, or generally means that it's the person that's entitled to the benefit of the dividend attaching to the share. And in a South African context, there was a court case also on this, and that was the Ocean Commodities case. And in this case, the court said that one will look at who is this person, who is the person who has the benefit of all the bundle of rights constituting the share. So SARS also sets out a lot of guidance on this in their comprehensive guide to dividends tax. And there they state that one would follow the decision of the Canadian case of Velcro Canada. And in this case, the court basically referred back to another case called the Prevost case. And in the Prevost case, the court said that one would look at who has basically the four elements of ownership. And the four elements consist of possession, use, risk, and control. And SARS says then in the comprehensive guide to dividends tax that the person who is the beneficial owner is the person who enjoys and assumes all the attributes of ownership. And it's only if the interest in the item in question gives that party the right to control the item without question will it meet then that test in the Prevost case. That's everything from my side. I'm now going to give over to Robyn.
Thank you so much, Esther, and thank you for everyone this morning on this session. That concludes this session, and we're now going to move into a panel discussion. I'm going to ask everyone to please bear with us because, as you know, I'm technically challenged at the best of times. But can I ask Pravisha if you would please come up? Fiona, hopefully you're there, and all the Bowmans members that are joining our panel discussion. Mike, can I have you up on the stage, sir? And if you don't mind, I'm going to sit back here so I can see there and talk to all of you. Thank you. And hopefully everyone online can hear me as well. Okay, so as Barry mentioned right in the beginning, we're very, very honoured to have Fiona Thomas on this panel with us. Hi, Fiona. And Fiona is representing Standard Bank. I think most of us know who Standard Bank is, but just, you know, for a brief outline. Standard Bank, well, Fiona, I should say, is actually Standard Bank Mauritius, just to correct myself, being a subsidiary of the Standard Bank Group, which is one of the largest banks in Africa in terms of assets. And Standard Bank has been present in Mauritius since 2001 and is today a major finance player in targeted segments. It provides corporate and investment banking services to governments, parastatals, large corporates, multinationals, financial institutions, and international counterparties, and high net worth individuals. Standard Bank is considered a great strategic partner for investors using Mauritius as a platform to invest into Africa, leveraging on the seamless synergy which exists in the group to connect customers in, for, and across Africa. A big mouthful, but a really big, impressive bank. So thank you, Fiona, for being with us. And Fiona is head of client coverage. Is that correct, Fiona? Have I said that correctly? Great.
That's right.
And then
Thanks,
I'm
Robyn.
also
And thanks for having me.
Thank you. We're also very privileged to have Pravisha. Pravisha is here representing Phatisa. I've worked with Phatisa for a few years since joining Bowmans, and Pravisha is head of the investor relations. And Phatisa is a leading African private equity fund manager established in 2005. Phatisa focused on investments across the African food value chain and affordable housing, while balancing commercial returns with impact objectives. So thank you, Pravisha, thank you, Fiona, and thank you, Bowmans team, for being on the panel. Right, so let's start with the first question. There are currently 14 African countries that are members of the OECD Inclusive Framework, which has the aim of combating base erosion and profit shifting. These include Kenya, Mauritius, Zambia, and South Africa. But strangely enough, Fabiola and Ronald, I see that your countries, Uganda and Tanzania, have elected not to participate. So we'd be interested to hear why that is.
All right, so if I'm to go first, Ronald, we understand from our verbal engagements with the Revenue Authority and the other government officials that they're currently considering on whether the country is ready or not to be part of the inclusive framework. However, I believe that it's quite an important agenda, given that being a developing country, there's a heavy reliance on corporate income tax that is payable by the multinationals. So it's important to be part of the discussion and part of the framework so that we can see on whether we can attain a fair share of the tax that should be payable in the country.
Yeah, thanks, Robyn and Fabiola. For Uganda, really, I'm not going to tell you that there is a public statement or a public election for Uganda not to join. I know that the policy people at the Ministry of Finance, what they're telling us is that, yes, discussions are ongoing. This is a priority point for us to combat international tax avoidance, but for some reason it hasn't happened yet. So what I can see and what we see is that Uganda has been a consumer of OECD recommendations on the BEPS action plans in our domestic law. We have already adopted the Action 4 on interest limitations rules as per the OECD report, I think word for word. So I think it is going to happen sooner rather than later, but there is no specific or policy position that we will not join.
Thank you. So we look forward to soon hearing that Tanzania and Uganda have joined. As members of the OECD framework, there are 4 key action plans that must be implemented. Those are the compulsory action plans, 2 of which I think are the most relevant to today's discussions, being that measures must be implemented to combat harmful tax practices and prevent the granting of treaty benefits in inappropriate circumstances. The OECD hasn't been too prescriptive. They have given several ways in which people can implement these measures. For example, you could use the multilateral instrument, which is this magical once-off arrangement where you elect certain positions and you elect certain covered treaties, and based on that, magically all your treaty networks change through it. Or alternatively, you could elect out of using the MLI, and you could elect to rather have bilateral agreements and, to renegotiate bilateral agreements in place. The other thing that they really said was, please don't implement unilateral measures. Please rather come along with us, do it through these measures that we have a kind of global standard that everybody understands. So this morning we heard from many countries about unilateral measures in local legislation that kind of ignored that request from the OECD. So I'd be curious to hear, maybe Alex, you could start us off, or Andrew, from the Kenyan side, to hear what are your thoughts on this? Where's Kenya heading, for example? Will you use the MLI? If you do use the MLI, will you then undo your unilateral relief? Your unilateral measures? Where do you see this going?
Thank you, Robyn. I think I'll go first, Andrew here. From a Kenyan perspective, we've actually taken quite a number of steps towards realizing the BEPS initiatives around offshore tax evasion and profit shifting. I think this all started in 2010 when we became a member of the Global Forum for Transparency and Exchange of Information for Tax Purposes. We became a member in 2010, and in 2014 we then set up our own Exchange of Information office here in Kenya. And in fact, our Revenue Authority Commissioner General was the first chairman of the African initiative of the Global Forum. And a lot has happened since then, including the signing of 3 conventions, which I think are the most significant towards addressing the challenges around base erosion, tax evasion, and so on. The first instrument that we signed was in 2016, and this was the Convention on the Mutual Administrative Assistance in Tax Matters. And this literally set the stage for Kenya to start coordinating with other jurisdictions in terms of obtaining information to do with multinational enterprises or entities that were based in Kenya with cross-border operations. And we've actually seen Kenya make use of these provisions quite a bit. It's already sending requests to other jurisdictions and obtaining this information, which it is then using to aid in its tax investigations. The second convention that was signed came, I must mention that this first convention I've talked about came into effect in 2020, I think around November of 2020. And so we've seen the government use that convention to obtain information. The second convention that was signed was sometime in 2019. And this is actually what we call the MLI because it's what, Robyn, you mentioned, affect all the treaties that Kenya has in force currently. Kenya currently has 15 double tax treaties in place. And so in 2019, we signed the multilateral convention to effect changes to the tax treaties to prevent base erosion and profit shifting. As far as I'm aware, as of now, this instrument is not yet in force, but Kenya did sign the document. The anticipated effect of this, as you've already mentioned as well, Robyn, is that rather than go back to each treaty and renegotiate the same independently, the idea is to have this instrument contain provisions that can then automatically apply to all the treaties that we have in place. And so we intend to see that happening as soon as this convention comes into force. The third significant convention that was signed in 2021. And this was the convention on the competitive authorities agreement for the automatic exchange of financial account information. This is quite significant because this is the document or the instrument that then sets the stage to allow or enable financial institutions in Kenya to provide information to the competent authority here, which is the Kenya Revenue Authority through the Commissioner General. And the Commissioner General will then relay or transmit this financial information to do with the multinational enterprises in Kenya to other revenue authorities that are also signatories to these instruments. To give domestic force to this convention, our Finance Act of 2021 actually passed legislation to amend our laws to provide for common reporting standards. And there's a specific provision in the Tax Procedures Act, which then provides that financial institutions shall provide certain financial information to the competent authority within 12 months of the financial year end of the multinational enterprise. We are currently awaiting regulations to be issued on the thresholds for the financial information to be transmitted to the competent authority. Those haven't been released yet, but we do have some draft regulations that interested parties are currently giving their views on. The first exchange of financial information is actually anticipated to take place, was anticipated to take place in the month of September 2022, which is where we are right now. As far as we know, it hasn't taken place yet, but steps are on course to ensure that this happens at least over the next 2 months. So you can see we are already taking domestic steps as well here in Kenya to give effect to all these conventions that we have already entered into. In addition to the common reporting requirements, Kenya has also introduced into its laws country-by-country reporting requirements for MNEs that are in Kenya, who are now required to submit this information, whatever information KRA requests to do with their transactions. So this could be financial information, it could be information to do with ownership structures, personnel information, and so on, while of course taking into account data protection and confidentiality requirements. So that's on the multilateral conventions. Then domestically, Kenya has been negotiating or renegotiating some of the treaties that it has in place. The most recent being the Kenya-India Double Tax Treaty, which was renegotiated in 2016. The original treaty was signed and came into force in 1985. So given the changes around the trade that's taking place between the two countries, there was need to renegotiate these treaties. And some of the more interesting changes are around tax evasion measures. So this treaty, for example, the renegotiated one, says that each country is at liberty to introduce into its domestic laws provisions that will aid towards curbing tax evasion, which is very interesting given what you mentioned, Robyn, around countries moving more towards relying on the multilateral instrument rather than each of them going about instituting its own measures. In addition to that, and my final point is to what Alex already mentioned, which is that we do have local provisions in our laws. The general anti-avoidance provision that he already mentioned has also been mentioned by our colleagues in Uganda, Tanzania, and Zambia. In addition to that, there is the anti-treaty shopping provision, the 50+1 rule. So in summary, Kenya has taken quite a number of steps around meeting some of these initiatives under the BEPS program. Robyn?
Thank you, Andrew. I'm going to come back to that question and check in with Mike on it a little bit later. But just before we go there, I wanted to turn now to Pravisha and ask her, Phatisa, uses Mauritius in terms of, setup of funds. And I think you guys have been there for some time and you've gone through all these changes over the years. You also raised quite a bit of your funding through DFI funders. So I'd be curious to hear how that's gone and your experiences, because I think at one stage the DFI funders were quite uncertain about Mauritius or a bit nervous around it.
Yes, Robyn, thanks for that question. We've raised 3 funds, and when we first started raising our first food fund, there was a question, why Mauritius? there was a question on the tax regime. And how we got around that is we adopted international best practice, which was encompassed in our fund legals. And then at the time of raising our second food fund, it was during the blacklisting, while Mauritius was still blacklisted, and it was also at the time of the COVID pandemic. It was really, really challenging, but we were still able to justify using Mauritius as the preferred jurisdiction, also because of international best practice. But we're moving towards raising our third food fund. We are going to stay in Mauritius. And I think that the strides that Mauritius is taking in bolstering its AML framework and its tax regime is really going to help us in attracting new investors for Fund 3.
Thank you so much. That's really insightful. And it's really good to hear that, you know, it's a positive sentiment around Mauritius, because it is really a great jurisdiction to work with still. Coming to you, Fiona, I wonder if you could share with us what you've experienced around, you know, Mauritius and the evolution that it's taken, and, you know, coming onto the blacklists, the grey lists, and then coming off the lists, and how that impacted your business in Mauritius.
Thanks, Robyn. Hopefully you can hear me well enough. And as you'll hear, I'm South African by my accent. So look, it of course didn't just spring on Mauritius. It's been a number of years in the making. If I do say so, you know, did it halt investors from coming to Mauritius? Probably not. We didn't really see that as a bank. You know, deposits continue to flow. You know, not many clients pulled the plug, so to speak, and left Mauritius because of the grey listing. But new investment did probably taper off a little bit. So as we all know, massive LNG story across a couple of the Africa regions, Mozambique, Angola, Uganda, for that matter. And, you know, some of the, shall we call them, global players in that space, you know, would have had a second thought about using Mauritius as a platform as a result of the grey listing and the blacklisting. So perhaps we didn't get as much FDI as that, you know, we probably would have received because we were on that list. A few people were a little bit, you know, nervous about using Mauritius. But did we lose existing business? No, I don't think so. Certainly as a bank, we didn't see that. Another point is of course, banks are risk managers, right? No, we're not risk averse, but we do risk manage. And what that meant was a couple of things. I think one of your colleagues from Mauritius mentioned invasive KYC. Invasive was probably not have the best connotations to it, but there was certainly, you know, much more enhanced due diligence that was required for banks to take risk calls. So yes, KYC was probably a little bit more painful. And it continues to be something that, you know, since Mauritius has no exchange control, we're going to always have to do enhanced due diligence to make sure that we abide by the AML CFT regulations. Have we just started that? No, Mauritius has been doing that for probably the best part of 2 years. When, you know, when the jurisdiction got wind of we might be grey listed, we might be blacklisted, there was a lot of very swift action on behalf of Mauritius Inc., if I can call it that, to tighten up AML CFT regulations. And as a result, financial institutions to really tighten up on KYC. So as opposed to the outside world, it has seemed a lot more painful to do KYC, but I think it's absolutely justified in a jurisdiction where you have no exchange control. You need to be a lot more vigilant around money laundering, etc. So, you know, I think the important point as well is we're all trying to harness the power of Mauritius as a gateway to Africa. It's a very business-friendly environment. Regulation, you know, regulators are very progressive, and I think it's got a very conducive ecosystem to drive investment to Africa through Mauritius. I sound like a salesperson here, but it's, I mean, it's got a robust financial framework, let's be honest. I think from a legal, from an accounting, from a banking perspective, you know, you'd have to look really hard to find a jurisdiction with a more robust framework. And I think the reason why we probably weren't as hardly hit by the grey list and blacklist was because there was already trust in the system to say that, you know, you kind of tick most of the boxes. Yes, you've got a bit of work to do in some areas, but I think the regulators and Mauritius as a collective really got together, regulators, business people, and of course banks and legal firms and management companies got together and said, right, how do we fix this and fix this quickly? I think it took about, I know Fadil can correct me if I'm wrong here, but it took around 18 months for Mauritius to really just tick off a few of those boxes to make the FATF very comfortable. And I think 18 months is super speed, and I really take my hat off to Mauritius as a country for being able to get removed from that grey list that quickly. I know possibly South Africa might have a similar road to follow quite soon, but I think Mauritius as an IFC in creating that substance and creating that credibility really did really well. And I think, yeah, we're really excited about the future. We had a Standard Bank conference last week. We had some of your colleagues from Bowmans at that. And I think the feedback was very positive sentiment around people utilizing Mauritius as a gateway to the continent. And I think, I think, the future looks quite rosy for us. I think we've got a little bit of extra work to do just to make sure that we start attracting more investment and really road showing what Mauritius is all about. But yeah, it looks pretty good. I think investment flows are definitely starting to bolster quite a bit, particularly this year. I don't know if it's post-COVID, additional sentiment. Maybe Phatisa can help you there, but we've certainly seen investment interest pick up in Mauritius through certainly through our client base and through our target client base. And yeah, I think I'll maybe stop there. I don't know if hopefully I've answered your question, but happy to
Thanks, Fiona. Absolutely, that's very insightful. I think just coming back to the OECD framework and, the 4 pillars, well, the 4 key actions, I should say, and I want to turn now to Mike. And, Mike's talking on behalf of Bowmans in South Africa. And it's interesting to me that South Africa at this point has not yet brought into action or into force the MLI, and they're usually on the front runners in terms of wanting to be part of OECD initiatives and wanting to comply. But we see that this has not changed. But we're very lucky enough to see that we haven't had unilateral measures implemented either. But I'd be curious to hear your thoughts on where you think we're landing with that.
Thanks, Robyn. I think that's the common question I've been getting since 2017. When we actually deposited the list of companies or countries that we're going to include on our covered list as to when would this become effective. And I think for a couple of years I didn't have an answer, and at one stage the answer was that there was a process that needed to be followed to actually adopt this and to ratify this. But I think just in simple terms then, just a quick refresher, in 2017 South Africa submitted the paperwork to the OECD saying that we've got 76 covered treaties. And just by, in August, if you look at August 2022, of the 76 treaties that were included on the covered list, 46 of those treaties have already been ratified by counterparties. From a South African perspective, the good news is that the National Treasury and SARS, as we understand it, have met with the Standing Committee on Finance. And they've also made approaches to the National Council of Provinces, etc., and are they trying to push through that we get the ratification sooner rather than later. So I think it's imminent. So if it gets through this year or early next year, then we're going to have to deal with these issues, I guess, towards the end of next year. So I'm hopeful that that will happen, bearing in mind that the National Assembly and the National Council of Provinces both need to ratify it. So we're stuck on the ratification phase as to 76 of the agreements. Also bearing in mind, not all the agreements, say, for example, the USA are, would be dealt with, because the USA hasn't, I don't know even if they're going to participate, but there are 5 treaties that have been left out. So yes, the South African has adopted the principal purpose test, as of most countries. So I think that's going to be quite an eye-opener for tax structures that are already in existence and structuring going forward. But as to the 5 treaties that are not part of the covered treaties, treaties like Germany are included there. Those are going to be specifically renegotiated with specific terms inclusive. And then there were 2 treaties, strangely enough, Grenada and Sierra Leone, that aren't going to be impacted because they were found not to be compatible. So I guess those treaties are easy treaties. They don't have bells and whistles and the type of protection. But Yeah, I think going forward, principal purpose test will be the test that will be applied. And the caution always is for clients that have structures out there, as we normally did in South Africa, and I guess all over the world, you just put a block in place because that was the best block that your advisor gave you. It was in a particular country that had a low tax rate. So now you're going to have to back up the substance and all of those good things. So yeah, that's where we are in South Africa.
Thank you, Mark. That's a good segue into my next question. You know, I work with a lot of European clients, and I look at a lot of European structures, and the solution around BEP seems to be just add substance. And it seems to be that, you know, most countries globally will accept the principal purpose test. We know there are the few, with the US being the main one who kind of is the outlier who wants a limitation on benefits test, but most certainly are applying a principal purpose test. And there what we see the question to be is if simply one of your main drivers is tax avoidance or accessing that treaty, basically, then you would be denied treaty benefits. And we see that the solution seems to be, but I've got a team of 50 people in that country. How could that possibly be my motivation? And I think the question I have for everybody around this panel, and maybe we can start with you, Bwalya, because you're in my line of sight here, is it enough to say we have substance? Is that the answer? If you set up Mauritius and it has enough substance, does that overcome any kind of threat around an ANSI avoidance challenge from your revenue?
I think in our case, like I said, we don't have, a test per se yet, and they haven't set up whatever the minimum standards would be. But we definitely think, that being able to establish substance in the other country would help in you being able to obtain the tax benefits. Like I mentioned, the Zambia Revenue Authority is likely to use the anti-avoidance provisions to try and ensure that you then have something more substantive than just the basic, structure that would be there. And we have seen them enforce on that basis. So I think that would be the position for Zambia, that yes, you would have to have some substance, although, because like I said, it's not really the law. It would depend on the Zambia Revenue Authority and who is assessing or auditing you at that particular time.
And Mark, how do you think South Africa will see that?
Well, I think from a South African perspective, it's a purpose test, and South Africa has always looked at that as on a very subjective basis. So whether you have substance or not, I don't know that that's going to be the primary driver, unless there's certain concessions that the South African Revenue Service make. But if you look at where we have required substance, that would be in our CFC legislation, where they commonly refer to a foreign business establishment. So a fixed place of business, you conduct business through that fixed place. You have suitable people there, high-level staff, low-level staff, suitably equipped, a building, warehouse, a factory, a railway yard, or you have a mine, a hole in the ground. So that, I think there has to be that type of concession. Hopefully there will be. But as I say, if you look back to the court cases before the previous Section 80A and before the previous Section 103, those refer, and the test was similar, it referred to the main purpose, or one of the main purposes, which is similar to this wording, is the principal purpose, or one of the principal purposes is a subjective test. It's what's in the mind of the people that set this up. But I guess you can then test that intention or with surrounding facts. Now, what's quite interesting, it's a principal purpose test, but if you look at the current OECD commentary on the limitation of benefits clauses in this new article, that's in the commentary, there's examples there where they actually do look at the bricks and mortar and what you have there. So it's quite an interesting thing how it's interpreted globally. But having regard to the fact that it would be South Africa that's giving up taxing rights, it will be our revenue service that will need to determine whether we're satisfied with what's actually set up in the shop opposite the road. in our jurisdictions, and then also as to how you're going to prove the purpose. So it's an interesting time, and it's going to be a challenging time for taxpayers once this becomes effective, I think, because globally, and we've seen it, I've had guys from Australia fly out, and the problem solution is always to put an extra couple of blocks on. And this is pre-MLI, but post-MLI, it's going to be a different story. So.
Thank you, Mike. And Pravisha, I'm looking at you because I'd be curious to hear how this is impacting on your structures and your setup in Mauritius.
So yes, you're right. It's not just about achieving substance. It's actually fulfilling the purpose of the entities set up there. And so Phathisa's obviously done a blend of both. We meet substance requirements and fit for purpose in country. Yes, there is a cost to it, but it all works out in the end.
Thank you. And Fiona, what do you see as a result of all the substance requirements? Are you seeing people deciding to move out of Mauritius because of the cost, or are you seeing people actually happy to take the cost and go through the pain, and therefore it actually increases business for you?
So two parts to that question. I think firstly, yes, they will take the pain of the cost, because I think if we've actually done this exercise where you measure Mauritius as an IFC compared to, shall I call, the usual suspects, so Dubai, Netherlands, Isle of Man, etc. And when you look at the cost benefit, a lot of the DTAAs, the IPPAs, etc., most of the IFCs kind of tick that box. From a cost perspective, Mauritius, I think, certainly by the research we've done, it's probably a lot cheaper than the other IFCs, and you probably get a really good, experience with all of the skilled workforce, etc. Similar, if not better, than some of the other IFCs. So cost benefit, I think we're probably cheaper than, not probably, we are cheaper than the other IFCs. Are businesses willing to take the plunge and pay for their cost? Absolutely. And on the second hand, when you look at Africa regions across, across the continent, certainly in the Standard Bank markets, localization is very important, right? The spirit of localization is promote local economy above all else. And Mauritius is no different. We want substance here. I sound like a Mauritian, don't I? But we want substance here. We want the spirit of not just using us as a paper trail, but actually putting a button on a shirt in Mauritius, employing local Mauritians, using a lot of the advantages that Mauritius has, but setting up shop here and really looking at it from a long term. We don't really want suitcase people come in here, take advantage, and off you go to another jurisdiction. We really want long-term investors to be in Mauritius. So yeah, I think we certainly from our client base have seen a lot of large multinationals, not only what we call Afri-nationals, so businesses that have companies across different African countries, but we've seen a lot of the bigger multinationals in Europe, probably less so in the West, but certainly on the East. So a lot of Chinese investors coming into Africa, really thinking that, above Hong Kong, Singapore, Dubai, etc., Mauritius actually makes sense because we're the African IFC. It's a little bit cheaper, like I say, progressive regulators, etc. I've mentioned that before, and it actually gives them a really good, kind of risk-reward return in using Mauritius.
Thank you, Fiona. So a lot of what has been discussed this morning in the slides, and Uganda particularly, I wanted to just mention, Ronald mentioned the fact that there's a lot of scrutiny by local authorities or local revenue authorities around parties trying to access treaties. And what's strange to me is that in the context of, say, South Africa, for example, we certainly haven't seen a lot of questions around that from our revenue authority. And it was also curious for me to see that Kenya is now also becoming a little bit more aggressive around, inquiring around where is the tax residence of the Mauritian entity. So I'd go back to Kenya at this stage and ask, what are you seeing in practice around, challenging access to treaties, overlooking your domestic legislation that seems to want to unilaterally deny treaty benefits, but looking at things like beneficial ownership, for example?
Thanks, Robyn. Yeah, I think, just before launching into that, because I think this will get right into what you've asked. From a Kenyan perspective, for the longest time, the test was always the purpose test. And at least before 2015, what the entities had to do was show that there was a commercial justification for the transactions. But post 2015, what we've seen is focus on substance. And this is now around what is that substance? If, for example, you're paying consultancy fees to Mauritius, the Revenue Authority has moved into requesting for documents such as timesheets. You know, can you produce timesheets to show us what exactly the substance in Mauritius did for you to earn these fees? So I just thought I should mention that. I know it's a question that you had asked the previous panelists from South Africa, but I think it's a key point from a Kenyan perspective that it's a really big issue now. Coming into the application of treaty provisions vis-a-vis introducing domestic legislation, I'll first say that in terms of renegotiation of treaties, the last one, as I mentioned, took place in 2016, and this is before we signed the MLI to effect changes to our existing tax treaties. So we don't expect to see further unilateral or bilateral discussions that will take place outside of the MLI framework. Having said that, it's interesting to note that even the treaties that have been renegotiated so far are now containing new provisions that allow for unilateral acts by parties to these treaties, you know, which again goes to your point of, you know, should this really be happening when we have this multilateral frameworks? Because on the one hand, we are saying, let's do this through the multilateral agreements, but on the other hand, we are saying, you know, but don't worry, each of you can still introduce measures in your own legislation towards curbing tax evasion. So, Robyn, it's an interesting thing that we are seeing. It's contradictory, you know, and I think we are waiting to see how all this plays out once the MLI is ultimately enforced in Kenya.
Thank you, Andrew. I'd be interested to hear from Fabiola in Tanzania. What are you experiencing? Are you seeing that there's a challenge around application of double tax agreements on the basis of beneficial ownership or a lack of substance?
All right. So in terms of the anti-avoidance provision that I covered earlier, we have not quite seen the Revenue Authority invoking the limitation of treaty provision, but in practice they would just ask for example, a certificate of residence of the other party for them to confirm that that entity is resident in the contracting state. So they would not go a further step to confirm the ultimate shareholders and whether they're resident in the contracting state or not. And in terms of substance, we do not have specific substance rules. We would hope that substance would somehow convince the Revenue Authority to consider some tax treatments, but I would also expect them to rely on the, you know, theoretical or the specific provisions provided in the Act. So I would not see them being persuaded by the level of investment of the amount of substance that has been put in the country.
Thank you, Fabiola. Javed, are you there? I'm sorry, you don't show on my screen, but I'm hoping you're there. Ah, there you are, great. Javed, what do you see from the Mauritian side? Because very often when these queries come up in local countries, that needs to be supported by the authorities in Mauritius, really claiming their taxpayers as taxpayers. What do you see in practice? Is the MRA, the Mauritian Revenue Authority, are they standing up for their taxpayers? Are they helping them to fight these good fights, you know, in terms of accessing treaties?
Thank you, Robyn. Yeah, in Mauritius, we have not seen quite cases about the treaty benefits being denied, or whether the MORE has been involved in the discussion with the relevant authorities. But going back to your question, given that Mauritius has now added the mutual agreement procedure in the MLI, so definitely dispute resolution in terms of treaty benefit would be much more efficient. And I think this would be something which would make investment routing via Mauritius more comfortable for the investors.
Thank you, Javed. Mark, what do you think with regards to South Africa, why do you think we haven't seen these challenges where we see companies coming via Mauritius and other countries, into South Africa, claiming treaty benefits, but yet we don't see the South African Revenue Service questioning things like beneficial ownership?
Yeah, I think that's a good question. I think that's just a weapon that they have in the arsenal. I mean, you'll know when they do look, let's say, at companies that have come in via Mauritius. I think the first point is prove to us the residence. Okay, and once you've successfully dealt with that, that can be quite an elaborate process. Then they tend to leave you alone. But then once you've argued that the residence is not in South Africa and they accept it, then you move on to the transfer pricing. And if the facts permit, then they look at the CFC legislation. So you've got three massive, strong points to look at that protect the South African tax base. And in terms of dividends flowing out, I guess you're picking up the 20%, but to the extent that there's a tax treaty, and we've seen that as well, sometimes they do call for the foreign residency certificate, but you're just getting a residency certificate. So I don't know, it might be an issue with the amount of people that they've got working to try and enforce, but I think they've been successful enough on residency challenges to pull a lot of companies into South Africa, and then on the transfer pricing and CFC side as well. So I think that's pretty much why. I don't think there's any other reason.
Thank you, Mark. Let's move away from tax for a moment and let's focus on the measures that have been implemented around the anti-money laundering. I know that those have really caused a lot of difficulty. For example, within the private equity space, very often we see that ultimate beneficial owners do not want to be named or disclosed. Why that is, we don't know, but very often there's family money right behind and they would maybe prefer not to be named and disclosed. So I'd be curious, coming back to you, Pravisha, where are you guys with this? How are you managing these new rules? How do you trace your ultimate beneficial owners? Is it impacting you?
Robyn, not really. Like you mentioned earlier, majority of our investors are development finance institutions. The only challenge we've come up is dealing with politically exposed persons. DFIs are backed by governments, and the individuals involved in managing their investments into our funds could be deemed as politically exposed persons, so just dealing with the risks around that. Other than that, we have seen a call for more intrusive KYC, as Fazil has mentioned. But it really doesn't impact us too much. Majority of our investors, our KYC all the way up to beneficial owner, is pretty easy when it's a development finance institution.
Thank you. Fiona, how are you handling that? Because, in the South African context, very often we have a Black empowerment partner, which could very often be employees of the business. So to undertake a beneficial owner test all the way up to, each individual behind that arrangement could become incredibly cumbersome. You could have hundreds of employees, for example, or you could be dealing with a situation where, it's people who operate in that business, that have the advantage of being part of that arrangement. So how are you dealing with those challenges? And are you finding, for example, people set up in Mauritius, but they have their bank accounts elsewhere? What are you finding is happening in practice?
So Robyn, absolutely. I think they're not setting up elsewhere, because I think if you look at KYC legislation, across all of the markets, so Standard Bank, we're in 20 markets. Mauritius is probably not the most extensive, to be honest. Some of our other countries are actually even more, I don't know, I want to use the word punitive, but they're actually even more, on the scale of extreme KYC. But, so do they set up accounts elsewhere? No. I think, when I compare, certainly as a South African, I compare FICA to FIAMLA, which is the equivalent in Mauritius. There are definitely elements, as I mentioned before, enhanced due diligence is required. So for the ultimate beneficial owner, I think we've been talking about that. We call it the warm body right at the top of any structure. We have to, there's just no two ways about it. You have to do it in terms of South African KYC. And, of course, we have to do that in Mauritian KYC as well. So it's not like a big shock to the system. I think, Pravisha has mentioned this. It's not a huge shock to the system, because it's something we've been doing anyway. It's not a new requirement to do the UBO, or the ultimate beneficial owner KYC. Where it becomes a little bit more intrusive is, of course, there are a lot of trusts. It takes a lot of time. And I think Mauritius is probably infamous for taking longer to do KYC. I certainly know we are. But it's because we have to go all the way up to warm body. Sorry, it's probably not the best words, but you know what I mean. And you've got to do trusts. When there's a BEE entity, as you know, a lot of minority stakeholders within there, you have to do KYC for every single one of them, depending on the threshold of how much they own in that entity. Typically in the South African FICA rules, any entity or individual owning more than 25%, you've got to do full KYC, address verification, ID, etc. In Mauritius, that's 10%. So it is a lot more intrusive. So anything with 10% and above, we have to do full KYC. So you'll see there's certainly a bigger element of additional DD that we have to do. Is it painful? Absolutely. And I think that's why it takes us a little bit longer to get through the KYC process than most jurisdictions. But I look at other countries. I look at Angola. I look at even Nigeria to some extent, Mozambique. Even our Isle of Man team as well. They're up there with Mauritius in terms of enhanced due diligence. So it really just extends the time to do the KYC. Haven't really had refusal. I think most people understand AML CFT is not just a Mauritius or an African problem. It's like global. So everybody has to keep both eyes open. 3 sets of eyes on everything, and we haven't really had a reluctance. It's just a timing perspective. It does take longer.
Thank you, Fiona. So another key element of what we see coming out of the base erosion profit shifting OECD initiative is the talk about transparency and the need for poor financial institutions to gather a lot of information about their clients and report that to the revenue authorities, and then the revenue authorities across the countries are all swapping this information. But in between that all, we also came across all these leaks. We saw the Mauritian leaks, and we saw the Panama leaks and all the rest of it. So Mike, I'm going to turn to you and put you in the hot seat here and ask you, if somebody's name has come across a leak, or come out on a leak, should you immediately disassociate with them? Is that the solution?
Yeah, that's a difficult question, Robyn, but I guess the starting point is no. Let's just take a South African, for example. They may, for whatever reason other than tax, have decided to invest money in Panama. They may have got the exchange control approval, full authorization, and they may have disclosed everything in their tax returns. There's nothing more that's required. As long as they've complied with South African laws and regulations, and heaven forbid have done everything correct legally overseas, there's nothing why one should turn away that business. It's a different story where you haven't gone through the correct channels and you don't declare the income, which is then evasion, which is then an illegal act, and you can actually go to jail for that. So it's a criminal act. So I would say yes, at first sight, no, but you need to do your due diligence.
Thank you, Mark. So I think that, I think what we can say out of that is that there is a lot of, hype in the media around it, and it's like, sells newspapers, but the truth is having your name on that list doesn't mean you've necessarily done something untoward. Thank you. So when we look at this and we think that now suddenly, tax authorities are reporting information. I know South Africa's had to report, and we have a few banks in the audience, and we have Standard Bank on the panel, and Phatisa as a fund, I think, also has some reporting obligations. So has anyone seen, and I'd ask anyone on the panel, where suddenly a client has knocked on your door to say, goodness, they found this company that hadn't been reported, and these are the consequences? I don't know if anyone on the panel wants to chat to that. Fiona, I feel like I need to pick on you on this one. Have you seen any consequences around this, where suddenly accounts held by, Standard Bank Mauritius, for example, weren't reported by your clients, and now they're like trying to work out what to do with that?
Please touch wood. No. Robyn, I haven't had, well, I certainly have an instance. I've only been in Mauritius a shorter while than I was in South Africa, but I've been quite close to the Mauritian business, even from Rosebank. And I haven't, to be honest, we haven't seen any specific, I don't know, STRs, we call them suspicious transactions or anything like that. We haven't had, major incidents, if I can call it that. We, of course, keep our eye every single day on any adverse media on all of our clients and prospective clients. And so we probably pick it up as quickly as anybody would pick it up. But we really haven't had any instances of that. And like I say, I hope it stays that way, but we haven't had any particular instances, no.
Thank you. Thank you. Bwalya, I feel like you were going to say something, were you?
No. I think it's similar to what Fiona has said. We haven't seen that happening.
Okay. Makes you wonder what they're doing with the information and what's still coming, doesn't it? So moving on to the OECD's latest initiatives that are really filling the papers. I saw a funny quote on LinkedIn the other day where someone said, we really wish Pascal would stay and Pillar 1 and 2 would go, but it's not going that way. Apparently, Pillar 1 and 2 are really staying. So with regards focusing mainly on Pillar 2, where we're going to have this idea of a global minimum tax, Javed, what do you think will be the impact, in Mauritius? Mauritius really is, out the starting blocks here, ahead of everybody else, wanting to introduce legislation already to cater to this. But when you look at the level of withholding taxes that are being paid on gross values coming out of Africa, do you really think Mauritius will actually benefit anything?
Thank you, Robyn. While the global minimum tax has been introduced, the provisions are still very brief, and the computation and payment will be introduced via regulations. However, given the high levels of withholding taxes across Africa, I believe that the effective tax rate of MNEs will be higher than 15%. Hence, I do not believe that any type of tax will need to be added in Mauritius in line with the global minimum tax.
It's interesting because you now have a tax authority introducing legislation, and of course, if you introduce legislation, you must administer that legislation, and it costs money to administer that legislation. So are we saying that we're introducing legislation just to appease the OECD and the international community, even though we know it's not going to give us any actual value in our country?
Yeah, I think one of the reasons is to comply with the OECD, and also I think the MRA is taking initiative in having the people in place to actually try and see where any top-up tax is to be paid. But again, I think we will need to wait for all these through the regulations.
Thank you. Mark, South Africa is actually the only country besides Mauritius that has controlled foreign company legislation. Mauritius's legislation is fairly new. I don't think any of the other countries on the call have controlled foreign company legislation. And certainly when it was introduced, the idea was that global tax, everything globally of South African residents must be taxed, whether it's held through other companies or not. And when the legislation finally landed, it was a lot softer than we had thought it would be, where we had exemptions, especially the most important one being the foreign business establishment exemption. So if you had valid purpose for being outside of the country and sufficient substance for being outside of the country, we weren't going to tax that. And the driving force behind that concession was really about letting South African companies be competitive on an international scale. So now we have this idea of a global minimum tax. Do you think that we are now going to step back from that policy? Do you think we're going to continue with that policy? Will we adopt the global minimum tax? Where do you think this will take South Africa?
I think at best, Robyn, they probably, if they do decide to go, the way of the moving away from CFCs, it'll probably be a gradual phase out of that. The Minister of Finance did indicate in the budget speech this year that, they would be putting measures in place to implement global minimum tax, and I guess that's what we've committed to do by 2023. The unfortunate thing is there was nothing in this year's draft legislation, so it'll only come about next year and then probably only be in effect in 2024. But I don't know that it's going to bring any additional money into South Africa unless, because it depends how it's structured. I mean, you may be able to get more taxpayers into South Africa depending how you restructure the source rules. So those would be your big market players, your big multinational enterprises that maybe don't pay sufficient tax in South Africa or don't really have a tax presence here. So then you're broadening your tax base. And they'd have to pay a minimum of 15% here. But given that we're already at 27%, is it really going to make such a difference? But if it's a top-up tax and your effective tax rate is at the 10s and 11s, then yes, 4% of something massive could be quite substantial. So I don't think they immediately will move away from CFCs because of the fear of losing out on the revenue and people moving money out, moving offshore, etc. So only time will tell, I guess, but it will be a gradual approach, if anything.
Thank you. I just want to check in, Esther, are there any questions that the audience are asking? Fantastic. So let me go around the panel, and I can't see everybody on the panel on the screen. I'm sorry. So if I leave anyone out, please do shout your name and say you'd also like to give a last word. But let's start with Javed. What would you say to people listening in this new environment that we're really grappling with, substance, purpose, MLIs, AML, all these complex arrangements that impact business, making business so much more costly to operate on a global scale? What would you say? What's your advice to the parties on the call listening?
I think there are minimum substance requirement in Mauritius, but my advice is for companies or investors using Mauritius as a platform for investment in Africa to not limit the substance to the minimum substance set out in the relevant legislations. And I think we need to the people and functions concept need to be brought out in Mauritius, so such that there are indeed much substance in Mauritius. And also one thing which I have seen, which is very, very, very common nowadays, is the concept of central management and control. So we have for the past been happy by having 2 resident directors in Mauritius, and I see there have been some scrutiny in other jurisdictions where they have not been satisfied by the only 2 Mauritian resident directors as constituting central management and control in Mauritius. What the advice that we are giving is to try and see if they can appoint more independent Mauritian resident directors, which can add substantive value to the company, especially in meeting of directors.
Thank you, Javed. Bwalya, what would you recommend?
My advice to clients is just that they should seek advice on compliance with tax laws in Zambia. Zambia is implementing the OECD framework, and we have seen it enforcing or attempting to enforce certain of those provisions. For example, we have the robust transfer pricing regulations, We also have introduced taxation on e-commerce. And of course, there's also the prevention of treaty abuse. So I think it's definitely setting out what is sort of a new territory for most of our clients, and would say definitely seek advice. But looking to the future, we still think that Mauritius will be that favorable jurisdiction out of which you can do business out of. And we're looking forward to seeing what those double taxation agreements will look like with Mauritius. And I see that happening with other jurisdictions as well, a renegotiation of DTAs across the board. But
thank you.
Thank you for this opportunity. Thank you to everyone.
Thank you, Bwalya. Fabiola?
All right, thanks, Robyn. So for Tanzania, given that we do not have the double tax agreement with Mauritius, we're not a member of the inclusive framework, there's not much that I can comment on in terms of that area, but for the purpose of this webinar, I'll just say that the government is currently trying to push a positive, agenda towards attracting foreign investors. There are some incentives that investors can enjoy through the TIC, like I'd mentioned earlier, in terms of, import taxes, work permits, and any other additional incentives as negotiated with the National Steering Investment Committee. But also the government has recently approved a blueprint for regulatory reforms that aims at eliminating something they call nuisance levies, all these levies that would create hiccups in terms of investment in Tanzania. And the last point is that we've seen the Revenue Authority changing their tone and how they try to approach investors. They're more open to discussions currently, and so we think it's a positive change towards encouraging investors in Tanzania.
Fabiola, that is really good news in Tanzania, because there have been some really difficult positions taken in the past with the Tanzanian Revenue Authority for investors. Fiona, what would you recommend?
Thanks, Robyn, and thank you again for inviting me. I think two messages from me and from us at Standard Bank is Mauritius is open for business. We're here to support the African continent, making sure that investment comes through Mauritius to Africa. I think that is the first point. It's, we've spoken about how progressive and how, business friendly it really is. And then the second part is, don't be shy. I think as Bwalya mentioned, make sure that your clients are getting the right tax advice, make sure they set up their structures correctly from day one. And then my parting comment is that Mauritius is not just about tax. I think there are 20 plus different advantages for clients using Mauritius. Tax is just one of them, and it's becoming less and less of an advantage because of the minimum global tax. So I think the real kind of logo for Mauritius is that, it's business friendly. Tax is one of them, but it's one of 20. And I'll close with that. Thank you, Robyn.
Thanks, Fiona. And I think you raise a very important point, because, tax could be 30% of your income statement. It could be 15% of your income statement. So I think that, as a director or financial director, if you're not managing that line, you'd be, remiss in your duties. So you have to think about tax, but I agree, Mauritius has many other interesting avenues, and we'll probably highlight some of those in the discussion that's coming up later around IP ownership. Should we go with Pravisha next? Yes.
Suggestions and recommendations, yes, get the proper advice, but also ensure that you have fit for purpose operations in country, and also just pay attention to procedures, just to make sure that proper decision making is being taken in the right jurisdiction. And other than that, I concur with Fiona. Mauritius is a very friendly place. I plan on moving there. So yeah, don't be afraid of these new legislations and new regulations that are coming in place in terms of AML and CFT. Everyone's familiar with AML and CFT. We've been doing it forever. So don't be afraid. Mauritius is awesome.
Thank you. I'm leaving Kenya for last, the best for last. So I'm going to go to Mike next.
Yeah, I echo the sentiments of everyone, Robyn. I think, get the right advice, set the structures up correctly. And then for existing structures, those are not immune. You need to look at those and make sure that you've got the correct substance and that the purpose is all there. So you need a defense file, because if you weigh up the potential tax, the potential interest and penalties versus the cost of a review and a correction or mitigation processes, it's worthwhile.
Thank you, Mike. And Kenya, last words.
Thank you, Robyn. Glad to be last. So just three things from the Kenyan side. One is just for entities to be aware of the residency test, which is around management and control, that you can conduct transactions outside Kenya. So in Mauritius, you can sell your shares in entities in Mauritius, but the residents, or rather the people who are making those decisions are actually Kenyan residents. Just to be aware that the Revenue Authority here is starting to look at such transactions and to deem that because those shareholders or the decision makers are Kenyan resident, then those Mauritian entities engaged in those transactions are actually Kenyan resident, and therefore the proceeds arising out of that sale will then be brought within the tax legislation of Kenya and subject to our corporation tax rates. So it's a very important area that we are seeing the Revenue Authority looking at. The second thing I would mention is around the substance test. I did mention earlier that we do not have minimum standards for substance in Kenya, and we don't have any specific regulations or court cases that have determined the issue. So it's just a caution to ensure that where you have transactions with companies or entities based outside Kenya, just to make sure you're able to justify those transactions and that you're not paying amounts or sums to entities that will then subsequently be found to be shell companies. We've seen instances where the Revenue Authority is actually sending some of its officials on flights to Mauritius to confirm that those entities actually exist, only for them to get there and find empty offices. And that does create a current problem here. The final point that I would make that entities would need to be aware of is around record keeping, just to ensure that all documentation is kept well and preserved well, given the country by country reporting laws that were introduced in 2021, so that once that information is requested from you, or rather the timeline comes when you're required to provide that information to the Revenue Authority, then you have the information and you're not caught out, because there are sanctions for not providing the information within the 12 months stipulated by law. There are penal sanctions, criminal sanctions, fines, and so on. So it's just important to be able to maintain your documentation. I think that's it from Kenya, Robyn.
Thank you. Thank you. And I think that's a really important point. Bwalya, did I leave you out? I didn't.
No. I said
Great.
bye. Thank you.
Great. Sorry, you're always front and center of me in the screen here. So that concludes this panel discussion. I want to thank everybody who participated, but most especially our outside guests. Thank you so much for making the time and contributing and being prepared to share your experiences. Bowmans has an office in Mauritius, and we certainly feel very positive about Mauritius and the story that's yet to come and to be told around Mauritius. And the use of Mauritius as a springboard into the rest of Africa is certainly something we are very still keen on. So thank you, and thank you for sharing your experiences. We're going to take a break now for half an hour. We were scheduled only to stop at 15:15, and because we're balancing online and offline, I'm going to keep to the schedule and say we'll start again at 12:45. And at that stage, we're going to start to look at Mauritius as an IP ownership jurisdiction. So hopefully everyone online will come back and join us in a few minutes at 12:45. Thanks. Hi, everybody. It's 12:45, so I think we're going to kick off now. I see the numbers online are quite low at this stage, so I suspect hopefully people will start joining again in a little while. But I'm just conscious that everybody is quite keen to hear this aspect of the chat. So I think we'd like to kick off. We're going to be examining at this stage Mauritius as an IP owner and the case for centralization of IP ownership through Mauritius. I want to just point out that it's impossible for us to answer every question that everybody would have in this scenario, because when it comes to IP, things are so unique and so specific to certain individuals and your organizations and your structures. So I'm expecting quite a lot of questions to come through, but I suspect a lot of them would probably have to deal with post-event, but feel free to put questions into the Q&A chat. We're going to kick off now with our colleagues in Kenya. Ariana is going to kick us off to start in terms of understanding the case for Mauritius as an IP owner.
Thank you, Robyn, and I hope you all had a good lunch. So, fortunately, I'm not a tax lawyer. I leave that joy to my colleagues Andrew and Alex. So I'm in the IP team in our Nairobi office, and I just wanted to explore and kind of set off the discussions for looking at Mauritius, where you are an IP owner, and considering that as a jurisdiction and as a possible destination. I will just give you a brief overview of intellectual property rights and things I would like you just to start considering about, just to give you some food for thought. Really, intellectual capital is recognized as one of the most important assets of many of the world's largest and most powerful companies. The role of IPRs in business, so intellectual property rights, is not well understood in a lot of companies, unfortunately. It's probably undervalued, it's undermanaged, and really underexploited. And there is sometimes very little coordination between different entities and particularly within a group structure. For companies with operating entities across multiple jurisdictions, what we have seen with a lot of our clients is that keeping track of your IP is difficult. It's cumbersome and really disjointed. We've seen some registrations happening in one territory and actually there's no protection in another territory. And in the end, you do need protection in multiple territories. So what I would want to set the scene of is, without appropriate IP protection, businesses really can miss out on business opportunities, particularly of licensing their IP, which is one of the best ways to really generate long-term business growth, and as well losing out on potential competition. The primary objective, which I would ask you just to look at and consider, is identify the relevant intellectual property and try and secure it before you monetize it, and certainly before you move it into one entity. So in the process of potentially considering having all of your IP owned by one entity, which would essentially act as the IP hold company. Sometimes it's called the IP, generally just the holdco or the IP co. You would need to consider, what does your IP consist of? For many companies where you are doing an audit for the first time, you really may be surprised by how many IP assets your company does own and how valuable these are to your business. And once secured, you then have a bundle of rights, which gives you exclusivity over these rights and really used as with any other asset. So for example, it gives you the right to use, to sale, to transfer, and even mortgage in some jurisdictions. So when you do this IP audit, I'll call it an audit, but you really need to look closely at your business to identify what are the intellectual property rights used in your business, and across multiple jurisdictions as well. Perhaps some of the IP in Uganda, for example, might be very different to the IP being used in South Africa. What is the value? And then the potential level of risk. For example, if you don't properly secure it, who owns it? When we've done IP audits, we've actually found out that in certain instances, the IP isn't actually properly owned by the company using it. And how can it be better exploited? So taking you back to basics, looking at what your IP could consist of. There is a distinction to be drawn between IPs that automatically exist upon creation and those IP rights that you have to register. So the easy ones, and not in any particular order from the slide, the easy one and one which I feel a lot of clients are very familiar with is copyright. So copyright protects the expression of the idea or concept. It's not, I have an idea, that means I have copyright protection. You have to put it down in some form. And interestingly and helpfully, copyright can protect web content, It can protect sound recordings, software, and in some instances also databases. So your database can also be your customer lists, sales records, and business contacts. You also then have design rights, which apply in the context of both registered rights and unregistered rights. So as an unregistered rights, you get protection for 2D or 3D shapes, probably more relevant in the context of any of our clients who are in manufacturing. And then looking to trademarks, these are registered rights, and I think a lot of our clients will be familiar with. They can exist as unregistered rights, but in order to properly monetize and benefit from that exclusivity that you can gain from a trademark right, we would always recommend registration. Trademarks are really a sign of origin. They can be a distinctive name, they can be a slogan, the Nike swoosh mark. They can now be, in some jurisdictions, be recognized even by registration by way of a smell or color. Smell is a bit harder, but it's an interesting point just to consider as well. You have design rights. So design rights protect the appearance of the whole or part of a product, and helpfully they also protect patterns as well, patterns and textures. So that might be particularly helpful for any of you that maybe have an embossment that you apply to any of your products. You should consider whether or not that is worthy of design right protection. You have patents, which are inventions, novel products, and innovative processes. And then it's not on the slide, but potentially interesting for any of our clients who are in the agricultural sector, plant breeders' rights, which are really designed to protect new varieties of plants. And then we move into more of the subtle types of IP, which are incredibly valuable, but really their value is enhanced by their secrecy. And this consists of confidential information. So you'll see trade secrets and goodwill on the slides, but really confidential information encompasses trade secrets and goodwill. And it really can be used to protect a lot of that which is not capable of being protected by other intellectual property rights. So these can include formula, recipes, which might not be apparent from the final product, processes, fermentation technology, for example, business methods until they are used in public, because then they're not confidential and secret, customer lists, plans and sketches and improvements, for example. So the distinction between trade secrets and know-how is that a trade secret is really a specific form of confidential information, which is commercially valuable. And if treated as a secret, really gives you a competitive advantage. Good examples of, I suppose, the worst kept best trade secrets are Coca-Cola, even the recipe for WD-40. And then from a tech aspect, for example, the algorithm for Google's proprietary search is a trade secret. It's difficult sometimes to properly understand by way of an audit, and it really then helps to keep a proper record, and that record again will then form part of your confidential information and really will guide a lot of your negotiations, for example, or discussions. We then move on to know-how. So know-how is more technical in nature. It includes knowledge of methods or techniques. So it's particularly more relevant in the manufacturing industry. Sometimes it can even be in someone's head. So it's quite difficult, obviously, to extract. Then finally, moving on to goodwill. So goodwill is also, I think, a word that is definitely a bit more familiar, particularly from the tax aspect, but it really refers to the value that a company can get from its brand, from its customer base and reputation, which is associated with its intellectual property. So it's really a long-term asset that generates a value for a company over a number of years. For example, goodwill of a trademark relates to the inherent value of your trademark, and which is the recognition of your mark among consumers and that extra earning power that it generates. You have, for example, the goodwill of a Gucci bag might be very different to the goodwill of a Primark bag, for example. So moving on to the next slide, now that I've given you an overview, in order to centralize your IP rights, you'll need to consider, in particular, where do you use those rights? So IP rights are territorial, particularly for those rights that are registrable you need to consider whether or not you should be registering them in the country of use. If you have one entity that registers the mark and that is responsible for enforcing and registration and compliance, particularly with it from an IP aspect, a lot of jurisdictions do permit registration by foreign entities. So a registration by, for example, a Mauritian entity will not hinder your registration. And once you have everything centralized in one location, it can then focus your operations and your efforts and your finances on proper licensing, deriving more value from a centralized system, and certainly the growth that you can gain from the licensing. And it allows for uniformity across your operations, your brand management, and your quality control and enforcement. These are all particularly important, for example, in franchise systems where brand management and quality control are crucial to the ongoing success and reputation. But just with that background and that food for thought, I'll hand over to our colleagues in Mauritius.
Thank you very much, Ariana. I'm just going to briefly go through what Mauritius has in terms of IP protection. So, as I mentioned earlier, Mauritius is quite a good and renowned destination for holdcos, and holdcos are used for investment. And as Ariana mentioned, IP is in some way an investment, and we have seen a number of investment vehicles being set up for the purposes of being a holdco, not only for shares and other tangible assets, but also for intangible assets. And it makes a lot of sense economically to have a holdco hold the IP and license to its subsidiaries the use of intellectual property in a way to centralize and achieve economies of scale. Now, Mauritius has, quite aside from the usual IP laws that we see, we have the copyright law, we've had the trademark law and the Patents Act for some years. But coupled with its advantages, its ease of doing business, its excellent treaty network, and the fact that having the banking system that it has made sense to, as well as having holdcos for holding investments, our holdcos have been used to hold intellectual property rights very frequently amongst in groups where there has been a decision to have a group holding vehicle in Mauritius to hold the shares in various subsidiaries operating in various countries in Africa, and that holdco would also then be the owner of all the intellectual property rights and license these, receive royalties in return, which are then part of the income of the holdco and therefore subject to Mauritius tax. There are, of course, some in-country tax considerations which arise, but then we would capitalize on our treaty network to structure these licensing arrangements in an efficient manner. Traditionally we had used what was known as the Global Business Category 2 company to hold intellectual property because it is an investment. But then in keeping with international developments when it comes to what is a legitimate holding of intellectual property, and so as not to fall foul on the rules of transfer pricing and harmful tax practices, the regulator now requires more substance when it comes to holding IP in Mauritius through a holdco. So these have to be the GBL, global business companies, which are subject to certain substance requirements, which Javed explained earlier, in terms of the core income generating activities being conducted out of Mauritius. So in some way, this approach sort of protects the IP owner in case that there is a challenge that there's no substance to that holding, or if royalty payments are being challenged by any tax authority. In terms of the protection that are given, could I have the next slide, please? So very briefly, in terms of the protection that Mauritius has, as far as IP laws are concerned, I mentioned we do have the Copyright Act, we've had the Trademarks and Patents Act for some time, but recently we've enacted a wider ranging Industrial Property Act. Mauritius is a member of the World Property Organization, WIPO, and has been trying to implement the recommendations of the WIPO when it comes to IP protection. So it is also, I have to mention, a signatory of the Madrid Protocol. So the Industrial Property Act now provides for a wider range of protection for all types of intellectual property, including patents, breeder rights, industrial designs, of course, marks and trade names. There are certain aspects of this law which are still in the works because the infrastructure has to be there. So, for instance, as part of the commitment under the Madrid Protocol, Mauritius should be able to recognize the validity and enforce the validity of a trademark which has been registered in another signatory to the another signatory country to the protocol. So this is expected to happen in the next year also, as the Intellectual Property Office works on the implementation of these aspects, mostly in terms of having the required infrastructure, the personnel, and the international register for those aspects of the law to work. In any event, even without the Madrid Protocol, we have in our case law principles under which the Mauritius courts have protected and enforced trademarks, marks which have international recognition. I have the very well-known case of Polo Ralph Lauren, which was not a registered mark in Mauritius, but the courts decided on the basis that it was a well-known mark. And these cases set out what are the criteria for deeming a mark to be well-known, have enforced the validity of this mark in the Mauritian territory. So these are quite interesting. It's a quite interesting landscape for owning and maintaining a registration of a mark. But there are some further incentives that have been added to strengthen Mauritius as a domicile for IP registration. And I'll just hand over to Javed to speak to that. Can we have the next slide, please?
Thank you, Fazil. Yes, there are certain tax incentives that are available for companies holding intellectual property assets which are developed in Mauritius. For example, we have an 8 years tax holiday for companies involved in innovation-driven activities for intellectual property assets which are developed in Mauritius. And this tax holiday is on all income of such companies. Secondly, we have 8 years tax holiday in respect of income derived by a company from intellectual property assets. So in the latter one, it's simply the income that are derived from the intellectual property assets that benefits from the tax incentive. There are certain conditions that need to be met. In the case of the innovation-driven activities, the activity has to be a new activity, i.e. should not exist in the market, and the activities should generate IP asset in Mauritius. The other conditions that are applicable to both tax incentives are that the company must carry out research and development leading to the creation of the IP in Mauritius. In terms of where the tax incentives are not applicable, a 15% tax is applicable on the royalty income, given that the royalty income doesn't fall within the partial exemption regime. However, any withholding tax suffered in any foreign country can be claimed as credit to offset any Mauritius tax liability. Again, the extensive network of double taxation of Mauritius comes into play. We have 44 double taxation agreements in effect, and a number of agreements are awaiting ratifications or signatures. Where there is a DTA between Mauritius and the country in which the IP is being licensed, the withholding tax on the royalty payment can either be reduced or exempted in accordance with that DTA. Thank you. I'll now pass on to Robyn.
Thank you, Javed. So it's a very common structure we find where IP ownership is centralized in Mauritius. And of course, that IP is then made available to various subsidiaries operating around the globe, predominantly across the African continent. And the question that often is, comes up is, how should we be dealing with the recharges or the charges that we'd like to impose in terms of giving access to that IP to our related parties? And this squarely fits into the transfer pricing regime, which Mauritius has a transfer pricing regime, as do many of the African continent countries. Some countries don't necessarily have a formal transfer pricing regime, but they certainly have an arm's length requirement. So the thing that becomes really important is to understand what should we be doing in terms of charging. So here we refer predominantly to the OECD guidelines on transfer pricing and this concept that I'm sure many of you have heard about, which is DEMPI. And I'll get to DEMPI in a moment, because what the OECD says is that first and foremost, what you do is you start with the rights that are contractual, and you look at those contractual rights and you say, legally, who owns this? Legally, who has the right of use of this? Legally, what have you given me in terms of a license or a software as a service arrangement or a franchising agreement or a royalty arrangement? And all these different types of arrangements have different meanings under the IP rules and impact the tax treatment. And we'll get into that in some of the slides coming a little bit later. But unfortunately, some countries interpret the meaning of what is a royalty and thus subject to a withholding tax differently to how other countries would interpret what is a royalty. And other countries will say that something like, for example, providing software as a service is not a right of use of IP per se, but rather that is simply a service that's provided to the other party and therefore should be treated under the business profits article in double tax agreement. So these are some of the things that we come to when we're looking at making available IP to subsidiaries underlying that Mauritian company or subsidiaries in the same group as that Mauritius company. But the OECD says, first and foremost, we must look at the legal rights, we must look at the contractual rights. Where, however, the facts are not necessarily documented in an agreement, or in practice, people are doing things that differ from what is documented in the agreement, then you look at the conduct of the parties, and that might be able to help you in terms of establishing a transfer pricing process and system. And what they also say you must have regard to is the intellectual property laws that protect that intellectual property and registration systems and how that impacts on the analysis. And I think one of the things that, you know, really needs to be taken into account is that IP ownership and transfer pricing don't always align. So if we could please go to the next slide. I think this is one of the most important elements to understand around transfer pricing and IP ownership, is that just because you're the legal owner of an intangible, that does not confer you the right to retain the profits that you derive from using that IP ownership, where you are using it within an intergroup arrangement. What the OECD says we really need to hone in on focus on is, where are the functions performed, where are the assets used, and where are the risks assumed? And those three key elements will basically tell us who gets what aspects of the profits that are made off the use of the IP. So if, let me give you an example, you're producing IP that allows you to manufacture widgets, and you manufacture those widgets in say Swaziland, but the person who developed the actual IP is sitting in Kenya, and we're saying that Mauritius actually owns the IP, but Mauritius is, you know, what we heard this morning, this concept of a post box. You know, in that scenario, you'll probably find that very little of the profit actually gets retained by Mauritius as the IP owner, because you need to remunerate the people sitting in Kenya who are developing that IP, and you need to remunerate the people sitting in Swaziland who are producing it. The only thing that could possibly justify some element of, you know, profit retention in Mauritius might be the risks that Mauritius assumes around that IP, if there's dangers in that IP and, you know, consumer exposure to you know, court cases, all the rest of it. So what is fundamental is, in order to determine an arm's length price, is you have to remunerate those people within, or those organizations those companies within your organization that contribute to the different aspects of, you know, making that IP the success that it is. So if we go to the next slide, we get this concept of DEMPI, and OECD says basically these are the 5 key pillar stones that we look at when we're looking at how to split profits within an organization around IP. The one is development, the other is enhancement, the other is maintenance, then we have protection, and then we have exploitation, being basically, it's such a shocking word, exploitation, but basically what it means is the marketing and the selling. Okay, so just taking one example there, for example, development, and we heard how Garven spoke earlier about the concept that, you know, Mauritius wants development to take place in Mauritius. But what does that mean, that development must take place in Mauritius? This is a very, very difficult thing to say for sure, how the courts ultimately are going to see this. Because, for example, if you have the lead IP person in your organization who's responsible for development sitting in Mauritius, But he can outsource that function to third parties sitting in, say, India for a much cheaper rate than hiring people to come and sit in Mauritius office and develop the IP. But he has complete oversight of that. He watches them on a daily basis. He checks in with the Indian staff on a daily basis. He directs them. He controls them. Is that sufficient to say that development has now occurred in Mauritius? And the questions, these types of questions are still going to be tested, I suspect, in courts of law, where there's lots of differing opinions in the market around what is sufficient to say that development took place in that territory. And the same with maintenance. So, for example, if you employ the services of your subsidiary sitting in Kenya or Ghana or Uganda or South Africa or wherever they are, and you say, you must please, not maintenance, protection, you must please help me to protect my IP in your territory. You must look out for people, contravening the rules of IP and encroaching on my IP and using my IP in an untoward way. Then who's really protecting it? Are you protecting it or are they protecting it? And is it enough to say that because the person with the ultimate responsibility of protection of that IP sits in Mauritius, even though they've outsourced some of those elements to other parts of the world, will that be sufficient? And with exploitation, that one is becoming increasingly more difficult in the digital economy, where, it might just be that all you do is apply to, Apple or to whoever it is that you're uploading your app to, and somebody sitting all over the world basically comes across an ad on Facebook or whatever it is, and based on that, they download your app and now they're using your IP. Where was that exploitation taking place? Where was that marketing and selling taking place? In the old days where you could say there was a shoe shop and somebody walked into the shop and said, I want this pair of shoes, it was a lot clearer. So these are really difficult concepts that we're dealing with in the context of transfer pricing. And these are the elements that will really drive home where profits should lie. So what's interesting is that in the US, there's been a recent court case, and in that court case, they examined the operations of Coca-Cola in some of the countries in which they do production and packaging of the products that they sell. And Coca-Cola had actually done an attribution of profits to these facilities that were manufacturing and selling on the basis of, they believed a correct transfer pricing position, allocating profits to these locations based on these activities. The development and R&D and all of that still remained in the US, however, and legal ownership of the IP still remained in the US. And Coca-Cola itself was still quite involved on a daily basis with these operations, telling them what, when, how, and why to do things. And the court said that they do not accept the way in which Coca-Cola has actually allocated their profits to these operations, because they have not had enough regard for the functions that are taking place in the US. And they have also not had enough regard for the fact that the US is the legal owner of the IP. And that for me was quite unique in the sense that these concepts of DEMPI almost want to completely disregard who is the legal owner of the IP, but this court case has said otherwise. So it's a very tricky situation. And I know when we sent out invites, there were questions around how do I price my IP, if I'm going to own it through Mauritius and use it elsewhere. Every single aspect will be individual. Every single case will be individual. You really do need to reach out to transfer pricing specialists, work with transfer pricing specialists and income tax specialists, because when you start to charge for IP, it has knock-on consequences. And we're going to go through each country again now, where you will see very often the cost of your IP charge is added to the cost of your good, thereby raising the cost of your import duty. And the other thing to bear in mind is that, very often charging, especially within African countries, for the rights of use of IP triggers withholding taxes, triggers transfer pricing audits, and may trigger, deduction limitations without corrections to the level of withholding applied. So very careful analysis is always needed when entering to arrangements of this nature. At this point, we're going to turn back to Kenya and ask you to kick off around how Kenya treats IP arrangements that are charged from Mauritius through to Kenya in terms of right of use arrangements.
Thank you, Robyn. So the first thing to look at is the definition of our royalties and our tax laws. It's an old definition that takes into that only considers intellectual property as was probably understood 10, 15 years ago. It doesn't, for instance, include software and a lot of these digital assets we are talking about. However, despite the definition, when you come to things like software and the license fees charged thereunder, those will be taxed in the same way as royalties. Now, our tax laws do not distinguish between royalties, license fees, franchise fees. They are all treated in the same way. When it comes to the actual treatment, number one, assuming this intellectual property is provided by a Mauritius holding company to a Kenyan entity, that will be an expense in the books of account of the Kenyan entity once the payment is accrued. So from a general perspective, it's a deductible expense and it attracts withholding tax when paid. The withholding tax, the standard withholding tax rate is 20%. Double tax treaties sometimes reduce this. The rate under the Kenya-Mauritius double tax treaty is 12%. However, that treaty, as we discussed earlier in the day, is not yet in force. Just moving on to the next slide. In terms of deductibility, the expense, the royalty, license fees, franchise fees, whatever you want to call them, will only be deductible provided they have been incurred to an income. So we've seen situations where with multinationals, they have lots of registered intellectual property, brands, etc. These are provided to the local subsidiary, but not all of them are going to market. Perhaps only one or two of the brands are active. Now, the revenue authority would want to limit the cost because some of the brands being licensed and for which a license fee or a royalty is being paid are not actually utilized to earn income for the local subsidiary. Then there's the question of anti-avoidance. The issue there relates around the pricing. It's linked to the transfer pricing issue, which is that the fee that needs to be charged, as Robyn just discussed earlier, needs to be at arm's length. It needs to be the fee that would be charged if these were unrelated parties transacting with each other. And typically a transfer pricing analysis will be required for this purpose to show that actually this is the fee that were these completely unrelated parties transacting, the Mauritian companies providing the relevant intellectual property to the Kenyan company. This will be the fee that is charged. And only then is it an allowable expense. We discussed earlier about our anti-treaty shopping provision. We've had instances whereby parties seek to set up an intermediate holding company, just because in a particular country, just because that country has a double tax treaty with Kenya. Now, there are laws in our Kenyan Income Tax Act that prevent that say essentially you need to show that your underlying ownership, a majority of your underlying ownership is in that particular country, or that entity is listed in that country. The next issue is situations whereby a brand or intellectual property is provided by, say, the Mauritian holding company to the Kenyan local company, but actually no royalty is charged. In such situations, the revenue authority has been known to say, we consider there is a charge, just that you're not including it here, and that charge is included in the cost of the goods sold. So they deem a charge so that they can claim withholding tax on that deemed royalty. Moving on to the next slide, royalties have VAT implications in situations where it's provided by an offshore company. So in this case, our Mauritius holding company is providing the intellectual property to the Kenyan entity. That's an imported service because it's being provided from offshore locally. That's an imported service from a VAT perspective. The Kenyan company needs to account for VAT on that. Now, if the Kenyan company, if all the supplies of the Kenyan company are vatable, if its sales are vatable, then the net effect is nil and there's no VAT to be paid. However, if some of the supplies of the Kenyan company are exempt, for example, insurance for these multinationals, then when it imports that service, that becomes a cost to the Kenyan entity. Once it imports the intellectual property, and it needs to account for 16% VAT on that. And then when it comes to customs and valuation of goods imported into Kenya, and I believe most jurisdictions where the intellectual property provided is a condition of the sale of the product, then the valuation of that intellectual property needs to be included as part of the customs value of the goods. So our customs authority enforces this quite keenly in relation to interrelated group transactions where a Kenyan company is importing goods from a related offshore entity, and the import includes the goods are going to be sold under one brand, under the same group brand. The customs valuation will need to demonstrate that this is the value attributed to the royalties or to the intellectual property. Otherwise, the Kenyan authority would upmark the value of the goods to include that customs value. Just moving on to the next slide. The newest thing, the newest development in our laws, and again, this is a worldwide feature, is what happens in relation to intellectual property provided digitally online. In the last 3 years, there's been a lot of development on the law on this issue. There's two implications when it comes to either services are provided online of our digital marketplace or goods. This, from an income tax perspective, any revenue and from Kenya digitally from providing either goods or services of our digital marketplace, those attract 1.5% tax, income tax on the gross amount accrued from Kenya. And then our are also liable to 16% VAT, again on the gross amount. I think those are the tax implications in such an arrangement in relation to intellectual property in Kenya, unless there are any questions. Robyn, back to you in studio.
Thanks, Alex. That's great. I think we're going to move on now to, is it Uganda? Yes, great. Thanks, Uganda. Ronald, you're up.
Thanks, Robyn. So the tax regime in Uganda is quite, it's not dissimilar to what you've seen in Kenya and Tanzania. There is a standard withholding tax for international payments for royalties on IP, only if the royalties is a Ugandan source. We have very elaborate source rules. For local IP arrangements, generally the royalties are grouped together with other property income and then taxed with business income as well. But for international IP, for instance, with the Mauritius, where the owner is in Mauritius charging a royalty, we have to ask whether it is Ugandan source. And since 2015, the source rules, as you can see, are quite wide. Essentially, any payment by a resident person in respect of IP as an expense of a business in Uganda is Ugandan source. So long as you have that cost on your income statement, wherever you're using that IP, we are considering it Ugandan source. And then, even if you're not you're non-resident, but you're paying the IP in respect of a Ugandan business, that also means it's Ugandan source. So there's been a challenge in how the URA typically enforces this provision. For example, a business in Uganda is using IP, but the payments are made offshore between two non-residents. No cost appears on the branch of the Ugandan branch, in the books of the Ugandan branch. It's difficult to see how they enforce that. So there's still a bit of uncertainty on how to comply with those provisions outside the requirement for transfer pricing. And then, of course, disposals of industrial intellectual property. If the income is arising out of that disposal, then it is Ugandan source. Next slide, please. So we move on to the definition. What is a royalty? As we can see, it's not dissimilar from the definition we have around the East African region. Any payment for use or right to use of IP covering motion picture, video, audio, television, scientific knowledge, technical and industrial and commercial knowledge, all of that is covered. So I think our definition is quite comprehensive, and any payment in respect of that qualifies as a royalty for purposes of taxation. Quite a common issue you're going to see in Kenya, Alex alluded to this, and Tanzania as well. We do operate a single customs territory, so our laws in respect to customs is the same. And this is a very frequent issue we see for people who import licensed goods, or for manufacturers who have international franchises and licenses and separate royalty agreements, franchise agreements. So once the Revenue Authority normally demands to know whether the royalty is related to the goods and it's paid as a condition before you can import those goods into Uganda. There have been frequent fights, especially whether the royalty is paid as a condition. And then what would happen to the VAT or to the taxes you already paid on the royalty? For example, scenario one, we have a royalty payment on which VAT and withholding tax is accounted for. And then you come down the road 2 years later during a customs audit, and then the revenue official is saying, this should have formed part of your customs value, you under-declared. This royalty is related to the goods and it's a condition of sale, pay customs taxes. But at the same time, not willing to refund the VAT and withholding taxes you already paid. So we've had a couple of those cases in court. Thankfully, they've gone in favor of the taxpayers. Next slide. So in terms of the treaty consideration, we already covered this in the first presentation. The treaty does reduce any payment to Mauritius to 10% withholding tax. The definition in the treaty of what is a royalty is not so different from what we have in our local law, so there's a bit of harmony there. But the limitation rules still apply. Section 88(5) still apply. The lower rate will only, you will only qualify for the lower rate if you can demonstrate beneficial ownership or substance in Mauritius. For purposes of VAT, most royalties, I would say most royalties are standard rated. If you pay them locally, the 18% VAT rate applies, except for a few specifically exempted sectors: agriculture, software installation for manufacturers, which is quite recent, enacted in 2021, telemedical services. So IP in those sectors is exempt from VAT, which is good, which was a welcome development. The one thing about Uganda that most of our clients find intriguing is that for international payments, which require you to, the payer to account for reverse VAT at 18%, since the royalty is considered an importation of a service at that point, that cost, that VAT cost is not claimable. So this has been the case since around 2012. It has been litigated multiple times, and the courts have all decided this is the law. You cannot claim reverse VAT on an imported service, whether be it a royalty or any other service imported into the country. And the policy reason given for this is that we are trying to make local suppliers competitive by making the offshore service a bit more expensive by imposing this additional tax. In other countries like Rwanda, if you have justification that in fact the service you're importing is not available on the local market, you will claim the VAT. That's not the case for Uganda. So this is something important to know in every structuring or in every pricing decision for IP that any client intends to make. Next slide, please. So in terms of what is happening in taxing the digital economy, Alex has pointed out that in Kenya, we now have a digital services tax. Uganda, as the little brother we normally follow close by, there are discussions to introduce that tax, but it has not yet been enacted. But we are expecting it to come through. For this year's budgetary changes, tax changes, the decision taken by government is that there will be no new taxes, but we expect that in the next cycle of tax amendments, we are going to have this tax enacted. What we do have is VAT for electronic services delivered to customers in Uganda, especially if the service is delivered to a non-registered VAT person. So that triggers a registration requirement and then a payment for that VAT on a quarterly basis. That is an allowance they give to only non-residents, as VAT is accounted for on a monthly basis under normal circumstances. So you need to register, or you get a tax representative, and then you start paying that VAT. Currently, the government has been, and the URA have been in discussion with the big tech players, Netflix, Google, Amazon, to make sure that they do comply with this VAT requirement. Facebook is currently banned in Uganda. You can't access Facebook without using a VPN. And one of the conditions I think they have put for them to do business formally is to account for all VAT on advertising revenue earned from Uganda. So that is going well for them so far. We have started, some of us who own private Netflix account, we've started to see the VAT charge incorporated in the cost. So there's a bit of heat around that area to make non-residents comply with accounting for VAT on services delivered to VAT non-registered businesses. Recall that we said that if you are importing the service and you're a registered person, then it's you who incurs the cost, the resident person. For the reverse, if it's an electronic service and the recipient is not registered, then the non-resident is required to register or get a representative to account for the VAT. So those are the key points to note from Uganda. Thank you, Robyn.
Thank you, Ronald. We're now moving to Zambia, if I'm not mistaken. Oh, Tanzania. Sorry, Tanzania.
All right. Thank you, Robyn. So for Tanzania, under the Income Tax Act, there's a requirement for a resident person to withhold 15% tax when making payments to a non-resident in respect of royalty payments. So a similar rate is applicable to royalty payments made locally. And the definition of royalty is similar to the one in Kenya and Uganda, and it refers to payments made by the lessee under a lease of an intangible asset and includes the use of or the right to use a copyright, patent, and similar items, but it also includes know-how and the use of cinematography, videotape, and similar items. We have been experiencing one challenge with the Revenue Authority in terms of the treatment of one-off purchases of software from non-residents. They would seek to treat these as payments for royalty on the basis of the definition that says the use of or right to use. But I think in my view is that they should also consider that royalty should only apply under a lease arrangement. So where there's a one-off purchase of software from a non-resident or locally, the Revenue Authority tends to treat that payment as a payment for royalty and impose withholding tax of 15%. Moving on to the next slide. In terms of value-added tax, if the payment is being made by a VAT registered person, the obligation to account for VAT in Tanzania will be on the person that is acquiring the service or is making that payment. And in terms of the VAT registered person, this will be applicable to entities that are partially exempt or persons that are partially exempt. This means that their supplies are made up of more than 10% of exempt supplies. So for fully taxable businesses, there is no requirement for the purchaser to account for VAT. But for partially exempt businesses, there's a requirement to account for VAT by way of reverse charge. So you would put in the output tax and also net off with the input tax to the extent that you're allowed to claim, taking into account the partial exemption calculations. And in terms of services provided to unregistered persons, the requirement to, there will be a requirement to register in Tanzania to the extent that the service constitutes an electronic service. And this includes access to software or databases. We'll see in the future slide. And from a customs duty perspective, as Ronald mentioned, we have a regional customs law, and therefore, similarly in Tanzania, royalty payments, to the extent that they form a condition for sale, they will be part of the value for customs duty purposes. And the challenge we have seen with this requirement is that at the time of importation, the party may not really know how much royalty will be payable to the non-resident. And so how much value should be put as an adjustment per the customs law. And then at the end of the day, if you do not include that, like Ronald had said, in future, the Revenue Authority will come and seek to, impose customs duty and other import taxes during their audit after clearance of the goods. Next slide, please. In terms of the taxation of the digital economy, we have had significant changes in Tanzania in July this year. One, in terms of the income tax obligations, but also the government has tried to simplify the modality for registration and payment of VAT in Tanzania for suppliers of electronic services. So for income tax, there has been an introduction of a requirement for non-resident suppliers of electronic services and digital marketplaces to register in Tanzania and account for 2% income tax on payments received from individual consumers of their services. And the income tax regulations were published in July, requiring the non-resident providers to register for VAT within 6 months of the regulations being effective. It means up to December, and the regulations do provide a very detailed list of services that would be regarded as falling within the scope of the income tax obligation. As for VAT, we have had a requirement for non-resident suppliers of electronic services to register in Tanzania since July 2015, when the new VAT Act was introduced, but we have had issues with the modality for registration, as the non-residents were first required to get a tax number before they get a VAT registration. And so most of them could not really obtain the registration and were unable to account for VAT in Tanzania. But the VAT regulations have also been published, simplifying the registration modality, and they are also worded similarly to those under the Income Tax Act. And so the scope of services is the same, except that for VAT, the requirement is to pay 18% VAT for services provided to unregistered persons. So this could be individuals or entities that are not VAT registered, unlike the Income Tax Act ones, which refer to payments made by individuals. So moving on to the next slide. Yeah, so we've covered the anti-avoidance provisions under the Income Tax Act and the Tax Administration Act. And in terms of the risk of the Revenue Authority stripping out a portion that they would deem to be a royalty from the profit that has been earned on goods sold by a local entity, we have not really seen the Revenue Authority do that. so far, but perhaps in future they may seek to do that in such an arrangement. Thank you, Robyn.
Thank you, Fabiola. Moving to Zambia now, Bwalya.
Thanks, Robyn. I'll handle this question for Zambia.
Hi, Joshua. Thank you.
Thanks, Robyn. Okay, I'll start by just giving a general overview of IP in Zambia based on what others have presented. So for Zambia, for the different IPs, we've got different legislation for that. But what's very beneficial is that there's no restriction in terms of a foreign entity owning an IP in Zambia. The only difference is that a foreign entity will pay a higher fee as opposed to when a local entity is applying for the same IP. And that is very important because I noticed it was the case from Mauritius. In Zambia, even though a trademark is well known, it will not receive protection unless it is registered. So I thought I should start with that. And then moving on to the tax implications. Like other jurisdictions, Uganda, Kenya, our Income Tax Act also has a definition of what a royalty is. And this definition is very comprehensive. And from that definition, it goes to say that it does not matter how you call that payment, whether it's a license, a franchise fee, provided it falls within the definition of a royalty, it will be deemed as such. And therefore, a payment will be triggered by that. The payment for a royalty, there is a withholding tax. If a payment is being made to a non-resident, a withholding tax of 20% is payable. If it's being paid to a resident, a Zambian resident, the payment there is 15%. In our definition as well, it defines a royalty to include a copyright. So when it comes to computer programs or software, under a corporate act, a computer program and a computer software is classified as a copyright. So by that, it means that all computer programs or software and any payments which may be paid for purpose of using that computer program or software would qualify as a royalty and therefore subject to withholding tax payment. I think this has been mentioned. In terms of payments, I think what will be triggered is the right to use the IP in Zambia. That would trigger, and any payment for that would ensure that withholding tax is payable. Secondly, so the right to use or the use of IP in Zambia, that would trigger the requirement to pay a royalty. Coming to the double taxation agreement, as earlier indicated by Bwalya, currently we do not have a double taxation agreement between Zambia and Mauritius. Therefore, the standard rates for withholding tax of 20% to a non-resident would apply. Robyn, next slide, please. Again, as earlier indicated by Bwalya, our Income Tax Act has a general and avoidance provision, and which is very comprehensive, and that is used by the Revenue Authority in terms to assess whether the transaction was deemed to reduce the tax liability or not. If it is ascertained that the intention was to reduce tax liability, the Commissioner General has got powers to recharacterize that transaction and deem a payment payable, and as a result, a withholding tax there. And furthermore, for Zambia, we've got a comprehensive transfer pricing rules, which have, I think, been enhanced over a couple of years. And the main requirement there is that if a transaction is between related parties, it is important that that transaction is done on an arm's length pricing basis. If not, the penalties which may be associated with that. On a similar issue, when it comes to royalty strip out, so the parties may agree that the agreement will have a 0% royalty. And from a contractual perspective, that is acceptable. But ZRA or the Zambia Revenue Authority may use its anti-avoidance provision and argue that part of a payment there should be a loyalty, and therefore withholding tax should be payable. Robyn, next slide, please. Okay. So for Zambia, once a royalty, withholding tax has been paid on the royalty, that is deemed to be a final tax, and no VAT will be imposed on that transaction, simply because under the VAT Act, that charging of loyalty would not be classified as a supply of goods and services, and therefore no VAT will be payable on that. I'll come to digital services when I'm looking at the next slide. However, when it comes to customs, I think our regime is similar to what has been discussed for Kenya, Uganda, and Tanzania. I think we use the same principle that the customs price should take into account the royalty paid. If that has not been taken into account, the Zambia Revenue Authority has got powers to adjust the custom price to include the royalty which will be paid, and then you'll be asked to be assessed on that basis. So I think on the customs, we kind of adopt a similar position as Uganda, Kenya, and Tanzania. Next slide, Robyn. Okay. To conclude, looking at taxation of digital tax. So in Zambia, we introduced this requirement of VAT on electronic commerce effective the 1st of January 2020. And the wording in the VAT Act is very comprehensive. It defines electronic commerce, basically any form of commerce which is done using the internet. That is to say the buying, selling, advertising, or marketing of goods and services, provided that is done using the internet or mobile telecommunication networks, that will be classified as an electronic commerce. And any provider of that service is required to account for VAT. And this is where that service is either performed, undertaken, or utilized in Zambia for the benefit of the recipient in Zambia. So provided the beneficiary of that service is in Zambia, the requirement to pay VAT is triggered. This is so regardless of whether the provider is in Zambia or outside Zambia, and whether that provider has got presence in Zambia or not. I think the triggering aspect is whether the beneficiary is in Zambia, and that will trigger the requirement to pay VAT. There's also a registration threshold when it comes to that. So if the turnover in Zambia for that electronic service provider is more than $50,000 US per annum, there's a requirement to register for VAT. Interestingly though, even though you don't meet that threshold, you are still required to account for VAT. The only difference is that you don't have to register for VAT, but you use your tax registration number to account for VAT. Furthermore, for non-resident service provider, electronic service providers, or providers who do not have permanent residence in Zambia, there's a requirement to appoint a local tax agent to account that VAT on your behalf, on behalf of the electronic service provider. In addition, the Commissioner General of our Revenue Authority has powers as well to appoint a local tax agent to account the VAT on behalf of an electronic service provider. Robyn, with those remarks, I think that would conclude for Zambia. Thank you.
Thank you, Joshua. So we're just going to run through South Africa now, and then that will complete today's events. If we could just go to the next slide, please. Thank you. So South Africa does levy a withholding tax on royalties. We levy the rate at 15%, but the royalties must be South African sourced and paid to a non-resident. There's no domestic withholding tax rate in South Africa. There's on domestic payments. It's only on payments from South Africa to a non-resident. And you can see on the screen there what the definition of a royalty is. It used to be slightly different. I'm now showing my age, but many years ago it used to include things like broadcasting and things that we've seen in other countries' definitions, but it has been narrowed down more to align itself with the OECD concept of what is a royalty. And just to bring in here and to really hone in on this idea that not everything is actually a royalty just because it's a right of use of IP. A royalty in the sense of a use of IP is actually, for a tax perspective, something slightly different to a license, for example, or software as a service. But not all tax authorities see it that way. For those of you that might be interested in understanding more about this and reading more about this, the OECD certainly has got some very good commentary on it, and the Australian Tax Office has issued interesting rulings on it. So there's quite a number of options to look at on the internet to see what is a royalty and what is actually something other than a royalty, even though it is effectively what is considered a right of use of IP. It's not exactly the IP itself you're using. And I know this is all very confusing, but you have to look at each circumstance. And especially when we come to things like franchise agreements are very often a combination of services and royalties. So again, we need to look at those very carefully in the pricing. South Africa has concluded a double tax agreement with Mauritius. It's a fairly new agreement which replaced our old one, and under that agreement, royalties withholding tax would be reduced to 5%, provided the payment is made to the beneficial owner of the royalty. We have a number of anti-avoidance provisions within our Act that could deal with cross-border royalties and, seeking to deny deductions or make transfer pricing adjustments. The first one is Section 23I of our Income Tax Act. This was aimed at something that they call tainted intellectual property. And without going into too much detail and very high level, what I would explain this to be is IP that was owned by someone in South Africa that is now being transferred to someone outside of South Africa. They are related parties, and South Africa is now charged a royalty for the right of use of that IP. And what happens is, in those circumstances, South Africa would be denied a deduction of the cost that is incurred to use that IP under 23I. What is very interesting is how this section plays with South African copyright law, and the fact that very often the owner of copyright is the developer of that copyright. So where you outsource development to South Africa and it's a related party, and then you have new IP owned and operated by a Mauritian entity, but yet made available to a South African company under a licensing agreement, the question is that 23I IP? And that's still one I think that's, the jury's still out on. Well, I look forward to seeing the first case on that. I'm sure it will come. Section 31 is another one where they can challenge you, and that's, of course, under the transfer pricing provisions, where they could say that, the arrangements between you are not market related or arm's length, and therefore there should be an adjustment. This would be the case typically where they feel you're overcharging royalties and the deduction in South Africa is too high. With regards to the risk of a strip out of a royalty where, for example, there's a right to distribute a product in the country, but there's no royalty for the use of the brand name, for example, we haven't seen that in practice. And I think that the real reason for that is most of our double tax agreements would actually reduce the royalty withholding tax rate to zero. And very few of them allow any element of tax under the royalty rules. So I don't think there's a huge amount at stake check there and under our rules. So it's not something that I think SARS would want to really invest their time in, but who knows? We can't always guarantee where they would go next. With regards to VAT, this is an interesting one because South Africa has a unique VAT rule whereby, you need to register as a VAT vendor where you carry on a business in South Africa, or an enterprise, I should say, in South Africa, and where your supplies exceed 1 million rand or are expected to exceed 1 million rand. And what happens here, therefore, is that very often SARS takes the approach that where you have a non-resident making IP available to a South African charging a royalty, that non-resident should trigger a VAT registration liability and then raise VAT on the invoices that are charged to the South African. It may be possible for the non-resident to apply not to have that VAT registration if they can show that it can be accounted for on an input basis. So in other words, under the imported services rules. Alternatively, they would have to register and levy VAT on the supplies to the South African party. Of course, where the South African party is not registered, that would be a cost to them. Where we have imported services, usually you don't need to worry about accounting for an imported service where it relates to the supply of a VATable arrangement. It's mainly those that have VATable and exempt supplies that need to really pay attention to imported services. We see this mainly in the financial services industry. The banks particularly are affected by it. And there they would run an apportionment ratio. So where there is IP coming into South Africa under licensing or royalty arrangements, there could be some VAT leakage there. We have similar arrangements to others whereby at times your royalty may be added to your value for customs duty. This is not the case, though, if it relates to the production of goods in South Africa. Then South Africa was one of the forerunners in terms of introducing VAT on foreign supplies of electronic services. And over the past few years, the definition of what is the supply of electronic services has really been expanded and broadened. And it's actually very hard to tell very often. So you need to be very careful and mindful of whether or not what you're doing over the internet or the emails or whatever it is you're doing, whether that is or isn't a supply of a electronic service. Again, you still need to meet the threshold, the 1 million. And, the minute you do, then you would have to register for VAT. I'm not going to repeat what's on the screen, and I'm sure you can all read it for yourself. With regards to the digital economy and taxing it further, at this stage, South Africa has looked at the idea of possibly introducing some kind of excise or customs tax around that. But I think for now it's been dismissed as an option. And the reason why they would look at it in that way is because simply introducing some kind of withholding would most likely produce very little revenue for them, because our double tax agreements would most likely prevent taxation of those amounts. So at this stage, South Africa is going along with Pillar 1 and Pillar 2 of the OECD. They're waiting for the outcomes, and at this stage, we'll probably implement those. But I think even on that one, the jury's a little bit out, and we'll have to see which way we go. I think one thing that, South Africa has that's unique is the exchange controls, and of course, exchange controls exist along many countries in Africa. And one of the things that Reserve Bank tend to be particularly precious about when it comes to exchange controls is certainly IP, and IP being exported from South Africa. So when you are a South African entity and you are wanting to, say, set up operations in Mauritius to centralize your IP there, one of the things that you really need to be mindful of is the exchange control rules. And the manual is very specific. The exchange control manual is very specific to say that when you want to sell IP to a related party outside of South Africa, that has to go to the Reserve Bank. And current policy does not allow for a sale of IP out of South Africa to a related party. If, however, you find an unrelated party who thinks your IP is really sexy and has a great future, there you can really just approach your authorized dealer. You show them why it is that the price is market value, and the non-resident unrelated party makes the payment for the IP, and the authorized dealer can approve the leaving of that IP from South Africa. Licensing of IP, an authorized dealer can approve, whether that's to a related or an unrelated party. But the key here is that you have to be able to show to that authorized dealer that what you're licensing, the returns you're getting are market related. So when it comes to related party arrangements in South Africa, when you apply to the Reserve Bank, to your authorized dealer for permission to enter into a license, you should present a transfer pricing document to support that, and not one that's been prepared by your own internal tax department, but rather one that's been prepared for an independent third party that verifies the market-related arm's length nature of the charges that you are making for the rights to use that IP, or you're bringing back into South Africa. And just be mindful of Regulation 6, whereby you would have to remit that royalty charge back to South Africa within the prescribed period. Then when you want to pay royalties to a non-resident, authorized dealers can approve payments to unrelated parties, but the Financial Surveillance Department of the South African Reserve Bank must approve payments to related parties. And again, there you need to have a market-related royalty charge, and it must be supported by a third-party transfer pricing arrangement to show FinServ that you are comfortable that what you're doing is arm's length and it is not depleting the South African balance of payments for no real purpose. Then when it comes to local manufacture of goods, that's not handled by the SARB or FinServ at the SARB. Rather, that goes to the Department of Trade and Industry, and there's a specific questionnaire that needs to be completed, and they will deal with the approval there. But each time you approach for an authorized dealer or the Reserve Bank for approval to, whether it be sell or license IP, you do need to have special documentation which accompanies it. The most important one always is that you must be able to show things are happening at market value, at arm's length arrangements, especially in the context of related parties. So just to also add that FinServ has a new procedure now where not only do they want all of that, but they want you to give them a commitment on what the likely value will be of the charges that will be paid out of South Africa per calendar year. They usually ask you to predict, certainly for the first year that we've seen. This is something that's fairly new. We're seeing it for services and we're seeing it for royalty applications. So that concludes today's events. I want to really thank the Bowmans team that have worked so hard with me to put this all together. I also want to thank everybody that came into the Sandton office, all like 3 of you that survived. Thank you. Thank you. And I'm pretty sure at some point we're all going to be back in person. I don't know how I'm going to accomplish it, but I'm going to get you all back, I hope. I'd also very much so like to thank the Bowmans marketing team and the business development team and the IT team, I should say, and everybody across the continent who's contributed to this. And those that are online, I want to thank you also for joining and sticking with us throughout the whole day. I know it can be quite long, but hopefully you've all found it interesting. And, for your specific items, please feel free to reach out to your usual Bowmans contact or the Bowmans office that you usually deal with, and we'd be happy to help you with anything. Thanks so much and go well.